All right, welcome everyone. Thank you so much for braving this North Queensland tropical weather to make it here today to the Community Tax Project Tax Literacy Workshop. I'm Catherine James. I'm the convener of the Community Tax Program or project. And what this project seeks to do is build capacity and links within and between the academic and community sectors to better advocate on tax reform in support of social justice. So we've run one event already this year. This is a pilot program we have running. So we ran one event earlier in the year, which was a public event on the Stage 3 tax cuts, which our friend Peter Mayers here kindly emceed, and Miranda spoke at that. Yeah, unfortunately, it's still a battle which remains unwon. And our second event is very much geared towards building capacity within the community sector so that you can better understand the building blocks of tax policy, so that you can better engage in the debates and discussions around tax policy. So to that end, we've assembled a stellar line of speakers, from our philosopher Dan to our economic modeller Jason, to our lawyer Miranda, and our economist John Quiggin, who'll be joining us online from Queensland. I'd also like to acknowledge that we're meeting on the lands of the Wurundjeri people and to pay my respects to their elders past, present and emerging. I'd also just like to take this opportunity to thank the Brotherhood of St Lawrence for allowing us to basically occupy this space to run this event. The University of Melbourne, currently there is a week-long strike on, and while we support the strike action, and indeed a number of members are here today working for free as a community outreach effort, we see this very much as our community outreach work, and given a lot of planning and organisation that went into the event, we proceeded, but at premises with one of our community partners. So thanks very much to the Brotherhood, and particularly to Emily Porter, who can't be here today but might tune in online, who is online. So thanks very much, Emily. So we'll get started with our first speaker. So Associate Professor Dan Halliday is from the Philosophy Department at the University of Melbourne. It's always a bit of a bugbear of mine that philosophers mostly ignore taxation, despite talking a lot about distributive justice and inequality. But Dan happily is an exception to that rule, and he's a real delight to work with. So he'll be giving you a bit of an overview of different philosophical perspectives on economic justice and the role of taxation. So I'll hand it over to Dan.
All right, guys, good to see you. Yeah, there we go. So yeah, my name's Dan Halliday. I'll try and keep this fairly light and breezy. I've only got about 10 slides. This is all going to seem a little bit theoretical, but I guess that's the point. And the serious details will be sort of delved into by my colleagues here. So what I want to do is give you. Any of you guys study philosophy at university? Just is that? Oh yeah, cool. Okay, yeah, don't be shy. Yeah. All right. For those who didn't, it's never too late. Right, so I'm just going to give you a bit of a sort of a crash course in political philosophy, or more specifically, theories of justice. So you know, what is justice as a sort of domain of morality? What are some of the key sort of positions that philosophers take at the foundational level? And how can we use these? To what extent are these foundational perspectives useful? And they are useful when it comes to thinking about tax justice more narrowly, despite the fact that, as Catherine said, taxation is not, with some exceptions, is not discussed at great length in political philosophy compared to some other issues. And then just a few other supplementary points I want to make. All right. Okay. Yeah, maybe you do it. Yeah, thank you. Yeah. All right. So philosophers like to distinguish between the concept of justice and conceptions of justice. The concept of justice is about what domain morality, what part of morality justice is, and conceptions are sort of competing refinements of that idea. So when philosophers talk about justice, when political philosophers talk about justice, they typically have in mind the morality of our laws, policies, and a certain set of key institutions Okay, fair amount of disagreement about exactly how to draw the boundary around that. But justice is supposed to exclude certain aspects of morality that are basically not the state's business, or only become the state's business when things really, really get bad, right? So textbook examples. I mean, it's an ethical question. You know, if I don't buy my mother a birthday card, I've done something morally wrong, but it's not really the state's business to make laws about that sort of thing, right? And more broadly, various aspects of personal morality that might be quite weighty, the state's supposed to keep out of unless things get really bad. So another textbook example would be raising children. Right? You sort of leave parents to get on with it. Things get really bad, the state steps in. Okay, but justice is the stuff that's front and center of the state's business. All right. Now, under that understanding that the concept of justice at the most abstract level is supposed to be, what does morality require, or what's fair when it comes to the regulation of those institutions in particular? Okay. Probably the most prominent political philosopher of the 20th century, at least in the Anglophone world, John Rawls. He became influential through developing this idea, right? So Rawls wanted to think of society as some kind of large scheme of cooperation. Right? If you're in a society, that means, in a very abstract sense, you're engaged in various cooperative relations with your fellow citizens. Justice is just about fair rules for running that cooperative scheme. Yeah, societies are cooperative things, interactive things. Societies are just when that cooperation proceeds in a morally defensible way, in a fair way. Right? That's about the size of it. And conceptions of justice or theories of justice are attempts to put some more meat on the bones there. Yeah. So first, I'm going to give you three sort of core theories or three conceptions. This isn't exhaustive, but I'm going to give you three of the more popular conceptions. So utilitarianism, you've quite possibly heard of utilitarianism. Simple idea, what justice requires. A society is just when its laws and policies and institutions are so arranged as to maximize the well-being of citizens, maximize the total or the average well-being of the citizens. Now, this will tend to favor, utilitarians typically like to think they've got some egalitarian, you can draw egalitarian conclusions from this, right? The idea of the diminishing marginal utility of resources, right? And any bundle of resources as possessed by a rich person is going to benefit that person less than a poor person. Or to put it more precisely, if you move $1 from a wealthy person to a poor person, typically that the loss to the wealthy person is going to be less than the benefit to the poor person, right? So total goes up when you redistribute. Also, it's got a sort of theoretical simplicity to it. Just maximize something. Find the resource that's the morally relevant one. Just do what you can to maximize it. There's something attractive and simple about that. And it apparently there's an air of impartiality about it, right? In fact, in the 19th century, when utilitarianism became popular, it was defended as a sort of progressive or even radical alternative to the sort of prevailing conservative morality, particularly in Great Britain, where, everyone should know their place. People are born into a certain class, et cetera, et cetera. Right? So number two, I've said utilitarianism has a kind of, is thought to have sort of egalitarian implications, but there's a more sort of full-blooded egalitarian theory of justice. Now, I'm simplifying somewhat here because there are many, many varieties of this, but I think the most intuitive way to characterize egalitarianism in political philosophy, particularly of the sort most relevant for tax justice, is a view that's sometimes called luck egalitarianism. So what justice requires is that we eliminate bad luck, or we eliminate the kind of bad luck that people didn't choose to be exposed to. So the intuition here is that there shouldn't be any inequalities that reflect differences in personal circumstances, unchosen personal circumstances, rather than personal choice. Inequalities are unjust insofar as they reflect these involuntary differences between citizens. They're just when they're the result of people's free, uncoerced choices. Right? Lots to unpack there, but something intuitive about the idea that injustice is about being worse off than you should be through no fault of your own. Okay, and then we've got social contract theory. This is the sort of theory that John Rawls went for. So returning to the idea that we should think of society as an elaborate cooperative scheme in some sense. Well, we can derive ideas about fairness and justice by staying quite close to that idea, right? So roughly, justice is about reciprocity, right? What you're entitled to is in some way related to what you put into the system of cooperation, okay? To put it another way, the extent to which you benefit from the system of cooperation, a lot of that is owed to the system rather than just your own efforts. So just to take a simple example, I'm always out of date with my elite athletes, but you know, Michael Phelps or Usain Bolt, right? They earn a lot of money, okay, and they put in a lot of work, I guess. But their talents only have market value because of the cooperative scheme that they're embedded in, right? Before the invention of television, you couldn't make heaps of money, even if you're the best swimmer in the world or the best sprinter in the world. So in that sense, they owe something. They owe something back to the society that has enriched them. That's how you can start to justify, among other things, certain ideas about taxation. All right, and contract theorists like to emphasize the idea that justice is secured only when you can justify to each person what's being done. So there's a contrast there with utilitarianism. All right, can we? So look, just staying at the foundational level, I'll just give you a sense of how the debate plays out, you know, within philosophy. So we still haven't got on to taxation particularly. Problem with social contract theory, an influential objection to social contract theory, is that, look, it's a nice idea that people should put something back in when they're able to get something out. An influential objection is what do you say about people who, through no fault of their own, can't do that? What does a social contract theorist say about someone with sufficiently profound disabilities that they can't enter into the kind of reciprocal relationships that other people can? What do you say about future people? I mean, the old slogan is that, you know, what's posterity done for us, right? Why do we owe anything to future people? Because they can't do anything for us. So that's very unintuitive. That's social contract theory. Problem with utilitarianism is that it prioritizes the total amount of well-being over it cares more about well-being than about the people who've got it. So the most influential objection to utilitarianism is that it's willing or even requires individuals to be basically hung out to dry when that's a way of increasing the total. Okay, it's morally required. Justice requires that you sometimes sacrifice individuals when that's a means of promoting the total well-being. Yeah. Egalitarianism, I think really the principal difficulty with the kind of egalitarianism that I've described is how do you properly unpack the difference between personal circumstances and personal choice? How do you know the extent to which someone's situation, like their position in the distribution, their salary, to what extent do you attribute it to them? To what extent do you attribute it to circumstances? A lot of discussion of that. What political philosophers tend to do is rather than attach themselves to one of these positions and just sort of go hard and defend it, they try and pick and choose the various advantages and disadvantages. Which one you get very elaborate conceptions of justice, which we really don't have time to go into, and that's partly for that reason we don't get onto taxation particularly easily. How am I doing for time, Catherine?
Good.
I'm doing good. How am I?
10 minutes. Good? You've taken 10 minutes.
I've taken 10 minutes. Yeah. I won't take another 10. Right. So yeah. We can talk till the cows come home, right? About the theoretical people like me can talk till the cows come home, I suppose. Other people like to move about the stuff I've just been talking about. But we want to get on to, questions of taxation and perhaps others. And as Catherine said, although there's definitely been an effort in the last few decades to bring political philosophy to bear on real world issues, taxation is not as prominent among these compared to things like the welfare state, education, healthcare, the things I've listed up there. Why is that? Well, can't believe it was more than 20 years ago now, but Liam Murphy and Thomas Nagel co-authored, Liam Murphy being a University of Melbourne graduate, co-authored what's become a fairly influential book on the full title is The Myth of Ownership, Taxes and Justice. I should have kept that up there. They take a sort of deflationary view about taxation, right? Like, once you've settled the questions of justice, or once you've picked your preferred conception of justice, there aren't really, that might conceptions of justice might, broadly speaking, favour progressive taxation over flat taxation or something like that. But after that, it's just whatever works. Okay, specific circumstances are going to favour some tax policy over another, but you can't really derive the details from a theory of justice. Okay, and so for that reason, less is said and more is said about the expenditure side, I guess, of fiscal policy, about what the priorities should be in, well, education, healthcare, labour market regulation, housing, that kind of thing. That being said, not everyone holds the Murphy and Nagel view, and I'm somewhat sceptical about it. Where philosophers have entered into the discussion a bit more fully, we might not talk about this today, but paternalistic justifications for taxation, right? So higher taxes on things like tobacco and alcohol. How justifiable is that kind of thing? Questions about institutional distinctions or types of legal status that have some bearing on tax. There's quite a bit written about that. So what kind of organisation gets to qualify as having charitable status, for example, which will have implications for its tax liability? That's an important philosophical question that's received some attention. And also, there's a tendency, I think, not so much in philosophy, but in wider society, to look to taxation as a sort of redistributive solution to contemporary problems of inequality, right? You get slogans like tax the rich, that kind of thing. That's good as far as it goes, but what's the division of labour, if you will, between taxation as a device of redistribution and other institutional mechanisms, right? Particularly things like monetary policy and the cost of borrowing, immigration. Of particular salience in the project that Miranda and I have going on is, what should we say, or what should the theory of justice say about the fact, to the extent that it is a fact, that older birth cohorts lived through a period of economic prosperity and accumulated wealth and benefited from a period of cheap borrowing, and younger birth cohorts around now are having a hard time accessing things like housing. And, to what extent is the solution to that one that proceeds through tax reform, but to what extent does dwelling on that question lead us to questions about, well, proposals about credit markets and monetary policy, and how does it all fit together? So conclusions, such as they are. So we'll hear more from other people about the finer points of tax policy. Political philosophy, I think there is more that philosophy can say than it has said, I think, about justice and the tax base, the rate structure, and in particular, just to promote our project a little bit, whether population aging and the rise of economic stagnation and this apparent inequality we've got between birth cohorts, whether that in particular means that justice requires some shift towards wealth tax or land tax or other kinds of tax reform. That there's more to be said about that. But at the end of the day, taxation is always going to be a moralized subject matter, right? It should be viewed as an institution that depends to some degree on your view about justice. And I think you can't really have a completely coherent position on what we ought to do when it comes to tax policy unless you're making some commitments about justice. So whether you're a utilitarian, a social contract theorist, an egalitarian, it's going to make some kind of difference somewhere. So if you can work out what you are, it might help you. All right.
Yeah. Well, great. Thanks, Dan.
Yeah.
Lots of questions.
Yeah, that's right. Dan has left ample time for questions. So
Did you want to stay up there or do you want to sit?
I'll stay up here, I guess.
Yeah. Does anyone have any questions for Dan? I mean, feel free to dig deeper into any of the theories.
Yeah, feel free
given
to
an
ask
overview
about
of,
more on that.
or to drill into more practical issues. And please say your name for the benefit of the audience too.
Chris Black.
Thanks, Chris.
So we had the Treasurer come and speak at our sample oration 2 months ago now, and his presentation was on all the different forms of doing government at the moment, and it was called Hard Heads and Warm Hearts. Like, where do you think his particular work at the moment, but also the current government fits into within your theoretical space? And where do we want them to, where would we ideally want them to be for tax reform?
I think well, so this is a point in a way about not really about the specific current agenda of the government, but about political conversations generally. Is that, and this is not just true of taxation, but it's particularly true of taxation. Conversations quickly become emotive in ways that sort of arbitrarily misrepresent various proposals, right? So, for example, so I wrote a book a few years ago about inheritance tax, and well, the case for an inheritance tax. And indeed, we don't have an inheritance tax in Australia. I've had it for a long time. A lot of people don't know that. A lot of my, you guys know it, but a lot of my students just don't realise that. And what happens when you talk about inheritance tax is people will start saying, "Oh, look, you're anti-family, you're anti-saving, you're sort of mean-spirited because someone's died and they're getting punished for it." And there's very, very little willingness or very, very little recognition that a lot of these, never mind what you think about those arguments, a lot of those arguments go for an income tax as well, right? I mean, income tax is not exactly pro-family. No one's died, but even the contention that inheritance tax is problematic because it's double taxation, well, that's not an objection to inheritance. That's an objection to the combination of having two taxes. You could use that if you're really serious about that point. You could use that as a reason to ditch the other tax, to ditch never mind how feasible it is, ditch the income tax and have it. So I think while there's recognition that, you know, it makes sense to talk about, what was it, cold heads, warm hearts, or hard heads, soft heart. Hard heads, warm heart. There's not a lot of consistency. So there's a recognition that this is moralized stuff, but there's not a lot of consistency about it. I appreciate I'm not really getting at the specifics of the recent proposals, but what we could really use is just a little bit more rigor, a little bit more, a little bit less appeals to emotion, or if you're going to appeal to emotion, do it consistently. That's what I think we could really use, in general.
Yep.
Just a question about the three rules for utilitarianism, egalitarianism, contract theory. So I understand they pick up the sort of redistribution part of tax, and taxes, but taxes also have other effects through the community. For example, taxes that impact housing prices, that then impact different groups in the community differently. Are those non-redistribution factors part of those, or are they something different?
Well, yes, or at least they should be. So when you talk about distributive justice, I think redistribution is a bit ambiguous, right? Between formally taxing one party and transferring either directly or indirectly to another party, or just talking about the way in which a policy will impact on people's distributive shares, right? So if we crank interest rates, we're going to do that, right? We're going to impose costs on some people and not on others. That, in a sense, is still redistribution because it's altering people's distributed position or their expectations of how their distribution position is going to go. So the short answer is yes. And in fact, I know that's monetary policy, not tax policy, but the point would generalize. Any policy that affects people's standing in the material distribution is going to be relevant to a theory of justice. With qualifications about different theories, going to put the emphasis in different places. But yeah, this isn't just about formal fiscal transfers from A to B. Yes.
I might just step in there, Dan, and ask you to maybe expand on the point that Murphy and Nagel made about the relationship between property rights and taxes.
Oh, yeah.
Because I think that's fairly relevant to the question asked.
Okay, so Murphy and Nagel were writing primarily for an American audience, right? So they're trying to respond to this popular feeling in America, right, where, you know, my property is my stuff, and that's sort of established prior to what the government does. And the government, through taxation and whatever else, comes and sort of takes part of it, right? So property is there, and then redistribute. Almost the term redistribution implies something after the fact, right? Or something that's adjusting something that has through force of nature or through independent means come about. And they want to be skeptical about that, I think, right? And, you know, rightly so, people's property holdings are a consequence of the system. This is to echo, they're not quite explicitly social contract theorists, but they're making a version of the point that, look, where you are in the distribution, including what your property holdings are, owe something to the system in which you've generated them. So the idea that private property is just a thing that's there that gets interfered with or adjusted or redistributed by the government is extremely misleading. And I think, what was it they say? They say it's a device of accounting or something like that, pre-tax income. Right? They don't really think that pre-tax income is really pre-tax.
Yeah, so I think that,
especially in moral sense.
yeah, so I think they make the point that it's conventional, which is just that it's artificial in the sense of that we have these conceptions of pre-tax and post-tax income, whereas they make the point that the state contributes to property rights, the recognition of property rights, enforcement through courts, through competition policy and so on and so forth, just as the state takes something through taxation, but it's all part of the overall system by which governs who gets to access what things. And so, yeah, so they're taking aim at that notion of kind of pre-tax and post-tax positions.
Yeah.
Toby?
Yeah, Toby from Centre for Policy Development. Just wanted to pick up, you kind of said before that thinking for policy discussions, we could get some way by doing less based on the emotion and the vibes and more based on the rigor of analysis, you know, starting from the conceptions of justice that we're going to get to. I guess, you know, what I'm interested in is to what extent or how could you see using these conceptions for specific policy proposals? Because the conceptions kind of help us assess whether an overall distribution is just, right? Like whether the final state is just. But if there's a proposal for, like, whether it's the same tax cuts, whether it's for a change to GST or whatever, isn't the worth of such a proposal like ultimately contingent then on so many other parts, like what it gets spent on, how the overall system works? How do you kind of see a way forward to bring that level of rigor to individual proposals as opposed to the whole system?
Well, bringing a level of rigor is partly just about recognizing when you're making an appeal to emotion and when you're making a more principled appeal, right? And then assessing that principled appeal. So, for example, what we just talked about might be an example. People say, oh, well, it's my stuff. Why should I pay tax? Or, you know, I created this wealth. And so, well, hang on a minute. What does that, how true is that? And what does it establish about your entitlements? And just as simple, and you can do that without settling really on what your conception of justice is. In fact, a variety of conceptions of justice are going to agree in large part about that kind of thing. A more controversial, I'm trying to think about the tax reform where conceptions of justice would, so they can be of help in that way, but they might also be of help in clarifying disagreements. When disagreements are sort of particularly difficult to resolve and appear in good faith, you can clarify that by tracing them to a more conceptual disagreement, right? So, okay, let me see if I can do this. Should private schools get tax subsidy? Right, people disagree about that. Well, if you believe in choice versus circumstance as per the egalitarian conception, then you can argue that, well, look, anyone who's at a private school is not there typically is not there through their own choices. They're there through their sort of family background and their family wealth. Why should they suitably develop that will lead you to one, you know, whereas other people are not, and what the state is doing is reinforcing. And this is going to be controversial, but a way of rendering more precise the moralized objection to the subsidy of private schools can draw on like egalitarian conception. A utilitarian conception might push in another direction, right? If you think that having some critical mass of private schools leads to educational diversity, and that leads to more experimental society, and ultimately thereby a society that's less homogenous and develops better, you can make a utilitarian argument, or you can start to make a utilitarian argument for retaining those subsidies. So that's actually one way, I think. I've done that on the fly, but that's one way in which I think you can trace elements of a real world good faith disagreement to a more conceptual disagreement, even if that's not always people's reasons why they take a position.
Mark,
Mark Jones at Tax Justice Australia. I wanted to raise a question about, I mean, you use the term paternalistic grounds for taxation. I guess the debate between, is there a debate in the literature between the kind of moralising, we're going to tax things as we think they're morally simple, versus if I'm allowing companies to sell addictive harmful products that then generate a whole lot of harm in the community, is there a justification for government to actually say, we're not going to allow you to externalise the costs, we're going to recover the costs of what it's actually causing in the community back on those goods, and therefore try and drive down consumption of those harmful goods.
Is there a debate? Well, there's certainly a recognition there's a difference between a tax that's designed to externalise externalities or prevent externalities, right? To prevent harms beyond the consumer, as might happen with, say, gambling, right? Versus a more sort of, I don't want to say illiberal, hard-nosed, we are making a judgment about what's good for you, and we're going to make it harder for you to pursue this thing. Yeah, there's recognition of that difference. Whether there's really a debate about where the line, the line's not necessarily that hard to draw, right? The debate is going to be return to the genuinely deterministic case. How far can the state go? Should the state go in saying, look, you are messing up your life, or you're making yourself worse off than you would be, and we're going to do something about that. And I suppose the theoretical parameters of this are really, when the state does that, how much background agreement is there between conceptions of the good life? So the textbook example again would be something like seatbelts, right? And these aren't even controversial anymore. I guess.
Unless you're in the US.
Well, even they're less controversial than so-called sin taxes around tobacco, right? And the reason for that, I think, is there aren't really people who can say, look, my conception of the good life, the life I want to lead, is hindered by this law, and I'm making a genuine calculation about it, still not comfortable, I want to take that risk. Whereas tobacco, I mean, people can coherently say, look, I know it's bad for me, but there are people who say it's part of my lifestyle, right? And it gives me a relief from stress, and so on and so on. And if the state can make a counter argument to that, it's going to have to work quite hard to maybe say something like, oh, but you started when you were a minor, and you don't give the same kind of moral weight to the decisions of under 16s, and the tobacco uptake is obviously at a young age. Or, yeah, it relieves you stress, but that's just relief from withdrawal symptoms, and your base stress level would be lower if you didn't smoke. So that's sort of how the debate will then play out. It tends to become empirical quite quickly. But the theoretical element is to what extent, if paternalism is picking and choosing among conceptions of the good, all right, it's it's harder to justify, is the orthodox view. If it's just sort of appealing to, look, either everyone has the same conception of the good, and they just don't really understand the risks, and we're just correcting that, which might have been the case with seatbelts. It's on safer, so it's on philosophically safer ground, I suppose, for one better expression.
Peter Mayers, I think those two are inevitably going to overlap, right? Where you're going to have an argument on a utilitarian basis. It's better for everyone if we tax gambling and tobacco and alcohol in certain ways. Overall, the benefit is, but then it's going to become moralised in the public discourse, because gambling is bad, and it doesn't just affect the individual who's losing all the money, it affects their family, and so these are probably inevitably going to get kind of conflicted. But the comment, my question would be, supposing there's no one from the Institute of Public Affairs here, and I'm wondering if they were here, what's the conception of justice?
Good, yeah.
From your schema, that they would say, hang on, what about this?
Did we ask him to come?
Probably not.
No, you should have.
So I think we need to know our enemies.
Right.
Yeah.
So it was not well, maybe they're not our enemies. Well, they're not your enemies. No one's an enemy in philosophy, right? Because we don't. Yeah. So I said it was not an exhaustive list of conceptions, but libertarianism or classical liberalism would be the fourth member, I suppose, and that would be the view that. Well, there's different ways of articulating it. I'm not sure what version of the IPA prefer, or if they even have a preference, but there's a distinction in philosophy between sort of English style libertarianism, which is coercion is bad. It's particularly bad when the state does it because it's got guns and prisons to back it up. So use it really sparingly. Okay, and that unsurprisingly, taxation is quite high on the list of libertarians, right? Unless it's taxation for like the military and the police, which is sort of there to prevent other coercion. I'm not trying to do a sort of fair job in that, but that's the English style. Then there's the Scottish style. I can expand on why I'm using these labels if you really want, but the Scottish style is less about coercion bad, freedom good, more about concentrations of power bad. Okay, which again leads to arguments skeptical about not so much taxation, but large government projects, right? Where you're not sure what the outcome is going to be. So classical liberals wouldn't, they'd applaud the decision to pull back from the Commonwealth Games. They'd have preferred that you didn't get so far down the road, but they'd applaud things like that. One important difference between classical liberalism and libertarianism is I think classical liberals have an easier time articulating a way about corporate concentrations of power. There's concentrations of power they don't like. That can be government, it can be corporations, it can even be, social norms and traditions and that kind of stuff. Libertarians, because they're more fixated on coercion, tend to end up being somewhat preoccupied with government than other forces. And that's an interesting difference. So if the IPA were here, I'd want to get them to pick which of those they're into, because you never really know. Yeah, that would be the fourth member, or the fourth and fifth member, perhaps. Yeah.
Just wondering on that conversation, trying to add a sixth member, what about meritocracy? What about the notion that people buy the notion that if I'm wealthy, it's a sign that I'm more valuable to society, and therefore the society should be structured to favour those to get ahead on wealth, and they should actually have more say in the society than people who can't generate wealth. They're less valuable to society.
That has a certain affinity with some version of the choice circumstance thing, right? So look, I started nothing, I worked hard, I showed merit, I deserve X, Y, and Z. Now you mentioned sort of seniority and institutional membership. That's taking things a bit further than just position and distribution, perhaps. But people go different ways as to whether this is an advantage or a disadvantage for you, right? Because the choice circumstance distinction, it still seems to allow for these big disparities in wealth or power, or so long as they have the right causes. People are uncomfortable with that, even if that's better than the status quo. So some egalitarian or lucky egalitarians become embarrassed by the extent to which their position might resemble that. Others are willing to embrace it. It's a tricky one.
So another kind of, it's perhaps more down the liberal line, but the Brennan and Buchanan. So I think another way of thinking about tax is to think, is there some way in which the fiscal bargain is a part of the constitution of the organisation of social cooperation itself, right? So Brennan and Buchanan wrote a book called The Fiscal Constitution. It tends to be associated with the right-wing end of the spectrum, but, Creary not necessarily or not always. It worries about coercion and control of the state, so it's sort of a line there. I mean, I'm interested in your view here, Dan, but they said some things about how, for example, welfare economics or utilitarianism might assume you need a certain amount of revenue because you want to deliver a certain amount of goods and distribution, and then what's the best way to tax? What's the best way to set up a tax system to deliver that revenue? Whereas the fiscal constitution would say you cannot decide ahead of time how much revenue you need. The tax system itself is part of setting up the framework for deciding about distribution in society. And you might get to a different view about distribution if you took that approach. I don't know.
That contrasts with the Murphy-Nagel.
It's a bit of a contrast with, so Murphy and Nagel, the thing I struggle with there is that they are very instrumentalist about the tax system, that it kind of follows from the system of social organisation that you choose. I'm not sure if you agree with this, Dan, but whereas the idea that taxes and property rights, you could put them together, are part of the forming of the constitution itself, the constitution of our society, the good society that you want, changes your idea. It removes, for example, the set amount of revenue you might want to achieve. Like that becomes an open question. That's a question about society itself.
And the rationale for that is in some way classically liberal, right?
It's kind of liberal. So I would say that is a liberal conception.
In an old-fashioned
liberal way. So I don't know whether that fits with any of the other.
I'd put it under classical liberalism because I'd put it under the view that we want to be really careful about giving the state certain kinds of power, and changing tax policy sort of on the fly is. Now maybe that's not the Brennan Buchanan. Maybe that's not the point they really want to emphasise. But I think that's how I
They
see it.
tended to want to reduce the size of the state. So in that sense.
Oh yeah, although size is one thing. People talk about big and small government. It's always a bit ambiguous. Like, size is one thing, but how powerful it is something else. Maybe.
We've got a couple more minutes.
I've got another question.
They're all just-
Let my go.
Yeah, Peter, why don't you finish it off with your?
So I just wondered about a couple of other, independent, on the other conceptions of justice that have come in here, or other philosophical approaches like ethics of care or virtue ethics. Do they have any bearing on?
Yes, they do. Or one way in which they do is as a criticism of the kind of egalitarianism that I put up. So the kind of, because we were talking about taxes, I put the emphasis on theories that emphasize material distribution, right? Because we tend to think about taxation as moving stuff around, right? One influential criticism of the kind of egalitarian view that emphasizes places in a distribution should occur for this set of reasons, but not this set of reasons, is that why you're so fixated on material position. A lot of inequality is about status rather than stuff, to put it broadly. And the relation between these two things is intimate. Like the wealth distribution bears on other demographic differences. But when you think about social hierarchy, right, race, gender, class, religion, and the list goes on, it's hard to kind of reduce it to something that you can put in an Excel spreadsheet for one. These are how people interact with each other as superiors to inferiors, or how people get treated in certain ways according to their group membership. And all of this has got implications for and causal connections with the material distribution. But there's a fairly elaborate debate about there's an influential line of thought whereby we should see the material distribution as merely something causally connected with social hierarchy. And justice is about eliminating the bad social hierarchies, which doesn't necessarily mean all social hierarchies, but the ones I put on that list. Now, ethics of care is, that's not quite ethics of care. Ethics of care is actually a bit more of a personal ethics position and virtue theory too. But there's an affinity. There's certainly an affinity, and there's this emphasis on the character of the character of our relationships with each other, rather than the stuff we've got, allowing that there was a connection of some sort. Yeah. So if today hadn't been about taxation, if it had just been a bit more about egalitarianism, I'd have said more about that up front.
Right. We might move on because we've got John online, but Dan will be staying till roughly about lunchtime. So feel free to ask more questions in the morning tea. But yeah, please join with me for thanking Dan for that. So it gives me great pleasure to introduce Professor John Quiggin, whose bio was on the website, but he's really a giant in economics, and again, one of the few people who take, really the time and care to look at tax policy, particularly from a socially progressive perspective, which is very rare in the discipline of economics. So it's a great pleasure to have John here speaking from Queensland today. He's giving you a bit of an economics 101 on tax policy. This is a version of a presentation he kindly gave to a group of my law students when I taught a course called tax policy. So it's a really useful overview to how economists conceive of taxation and the various debates and concepts that go on within economics. So thanks so much for joining, John, and I'll hand over to you.
Oh, thanks for having me. I'd like to acknowledge the traditional owners. I've mentioned that of the people, including Queensland is located, the Jagera people, and pay respects to their elders, past, present, and emerging. A lot of what I talk about, I think, will cover some of the ground you've heard previously, but from a different perspective. So, of course, tax policy is a big element of economic policy, and economists mostly have the running on formulating it, while I guess lawyers tend to have the final say in how it all gets interpreted. So as I mentioned, I'm at University of Queensland. You can find my blog, follow me on Substack and so forth. So first, our first question is, well, how much tax do we pay? This is, Joe Hockey is long gone from the scene, but as Treasurer, so as somebody who ought to know what he was talking about, he claimed that people work half the year to pay income tax. Now that's an obvious estimate if you look at the margin rate of income tax paid by somebody like Joe Hockey. It is indeed 50%, and that's the kind of number he had in mind. But that's incorrect, because we have a progressive tax system in which the rate of income tax goes up in increments as income rises. And so if the stage 3 tax cuts come into effect, we'll see only people earning above about 180,000 a year, I think, paying the top rate, which is a little below 50%. What we can look at is the revenue share of GDP or national income. That's about 27%, and that's a number that has been stable for a very long time after increasing over the course of the 20th century. It stabilised around the late 1970s. It's a number that's low by OECD standards, higher than some Asian neighbours, so particularly poor countries. Poor countries tend to have low ratios of tax to GDP. I can talk about that a little in question time if you want. It certainly wouldn't claim a causality, that is, that having low taxes makes you poor, but it's a characteristic of high income countries that they tend to consume a lot of the services provided or funded by governments, and that implies a relatively high tax to GDP ratio. So we can look at this measure. This isn't perfect, but what it shows among the member countries of the OECD is that Australia is down here, right near the bottom of the OECD in terms of the percentage of GDP or national income that's taken in taxation, and this European and Scandinavian countries at this far end much higher. The US just a little bit lower. And here's a picture of what's happened. I've only got the last 40 years here, so that omits the period, as I say, of the first 3/4 of the 20th century, when tax to GDP ratios rose fairly substantially. What we've seen is this very stable ratio going up to, I haven't updated these slides, going up to 2010. This hasn't really changed much. Hasn't changed much in the subsequent nearly 15 years. Governments have sought to keep these ratios very much constant. Ideally, given the prevailing neoliberal ideology most of this period, they would have liked to see it reduced. That hasn't happened. And we see that most of the tax is collected by the Australian government. That's a very sensible way of collecting taxes, but does create some big problems in the relationship between national and state governments, which I won't have time to talk about here. What is taxed? Well, the standard way in which economists divide these things is to talk about direct taxes on income and wealth, and indirect taxes on expenditure or consumption, taxes on production, taxes on imports and exports, and taxes on transactions. We'll go through all of these individually, but first we'll look at the mix between these two. What we see again is that Australia is actually more or less in the middle here in terms of these ratios. Historically, we tended to be relatively high in terms of direct taxation and relatively low in terms of indirect taxation, but the shift to the GST in about 2000 really put us more or less in the middle of the pack here. So we have a fairly typical tax mix with, as I've mentioned, a pretty low total tax take in general. So all that's saying, I think, those are things that you, on the whole, would not pick up from the Australian tax debate as it's conducted, for example, in the pages of the Financial Review and so forth, which tends to view first that we have a very high tax burden, and second, that this bears particularly through direct taxation, that is taxation on income. Neither of those things are really true. So what is income? It's the income tax is the biggest single source of taxation for Australian governments and for most governments. The Haig-Simons definition, the most widely used, although we see some disagreement in it, suggests annual consumption plus increase in wealth. That is, what you come in, what you start the year with, either you spend it or increases your wealth. That encompasses, therefore, things like capital gains, free consumption provided by employers and so forth. How does that fit into the Australian tax system? Well, we first have a personal income tax levied on a definition, which is essentially, certainly for wage earners, is fairly straightforward. Your wages, less income, less expenditures incurred in earning that income. On top of that, we have fringe benefits tax that essentially taxes consumption provided by employers, things like company cars and so forth, and capital gains. So until the 1980s, neither of these things were taxed. And just a brief aside, this is an illustration of the role of contingency in politics. In the early 1980s, there was a significant push to introduce a goods and services tax, a tax on consumption, led by the then Treasurer Paul Keating. He convened a major tax summit, trying to bring everything together with the idea that unions, community groups and employers would all join the government in agreeing to a broad-based consumption tax. And the way he did this was essentially to put up three options, two of which were designed to be unacceptable, leaving the third one, the consumption tax, as the inevitable outcome. But as it turned out, he was undermined by then Prime Minister Bob Hawke and by unexpected opposition, failure of business to support his preferred agenda with sufficient vigour. And we ended up getting what was designed to be one of the unacceptable outcomes, which included a fringe benefits tax and a capital gains tax. So, so that meant we ended up with, we didn't get the GST for another 15 years. And this can be compared to New Zealand, where things were pushed through, the GST pushed through at a rate which is now, I think, 15%, and where they never got round to a capital gains tax, or I believe a fringe benefits tax, although I'm less sure of that one. Because rather New Zealand has a massively more regressive tax system than Australia does, and I think that's reflected also in various ways that the way in which reform took place in the 1980s in Australia and New Zealand is reflected in New Zealand's subsequent very poor performance across a wide range of measures. Now, we also have a common income tax. Part of this set of reforms included essentially removing the double taxation of dividends. We can come back to the very strange version of this, which is the dividend credit, which was the major issue in the 2019 election, which effectively said you get the tax on dividends back even if you have no income tax against which to offset it. So the effect is that to the extent the tax company income is paid out in dividends, it's effectively taxed only once. Effectively, this provides a significant incentive to wealthy Australians to organise their affairs through companies and trusts, which has never really been tackled by any Australian government. Finally, payroll tax, a tax on wage income only. I mentioned that the great majority of tax is collected by the federal government. That implies being collected in a uniform way at a uniform rate throughout the country, but also implies that the state governments are dependent on the federal government for their income. There have been two big attempts to fix this. The first, around about 1970, was payroll tax. This was given to the states as what was seen as a tax base that would grow over time. The states then competed with each other to provide loopholes, exemptions, lower rates, and so forth. So the payroll tax never really delivered the goods in this, and a lot to be illustrated again the merits having a single uniform tax system nationally rather than having states collect their own income. Analytically, under certain circumstances, a payroll tax although it appears to bear solely on workers, for it does, the same is true of a consumption tax in crucial respects. So in appropriate kinds of economic models, payroll taxes and consumption taxes end up looking very much the same, which is kind of embarrassing if as many people do, you find payroll taxes, dislike payroll taxes and like consumption taxes, or vice versa. So again, here's our share. As this shouldn't be surprising, we know that we have a very low total tax take, and that our taxes, our tax mix is now fairly typical. So we have one of the lowest rates of direct taxes in the world, and in fact, even the US, which has a higher total tax take, doesn't have nearly as much, doesn't have as high indirect taxes as we do. So we see that we have very low direct taxes this year of GDP. Consumption. So we now have and have had for many years now the goods and services tax, which is a multi-stage value-added tax. And this is essentially the modern norm in how we tax things. And so what this means is that at each stage in production, the value of that production is taxed, the GST, but the producer is able to claim back the GST they've paid on their inputs. And this is important. This is important on the good side of the economy. The other thing that's important is that services are taxed as well as goods. So in Australia, this replaced a wholesale sales tax applied only to goods, only once in production, only once in the process of production. That was a very problematic tax because goods as a proportion of expenditure, production and so forth are declining. So this was a shrinking tax base. The multi-stage, the extension of to services is really probably the most crucial piece of this. But if we go back to the origins of it, it replaced so-called cascade taxes, which meant these were prevailed in France, which was one of the first places to introduce a value-added tax. And here, the tax was levied at every stage, so that if the farmer would be taxed selling wheat, the bakery will be taxed selling bread to the baker, the bread factory will be taxed selling bread to the baker, bakery shop, and then it will be taxed a third time when it was sold to consumers. That's incredibly inefficient and distorting. It means that the amount of tax you pay depends on the number of stages in the production process. That in turn produces all sorts of incentives, for example, for companies to integrate all the way along the tax chain. Nonetheless, we see this idea raised every now and then because it appears as if you can have a very low rate of taxation and still collect a lot of revenue. There's a version called Easy Tax, which Pauline Hanson was advocating for a while, and it certainly pops up every now and then. Nonetheless, I think unlikely to happen. The goods and services tax applies to most things, but in addition, we have special excise taxes on alcohol, tobacco, and petrol. All of these, again, handed to the Commonwealth in the Constitution, which had the unfortunate effect of depriving the states of getting other sorts of revenue they might have had originally from petrol taxes used to fund roads. So again, Australia right down low on indirect taxes. We have a few taxes on production, mineral resource rent taxes and royalties, partly reflecting, of course, the relatively unusual Australian situation where minerals belong to the nation or the Crown rather than to the landholder under whose land they're found. But also we have pollution taxes, carbon taxes. When I was first given this slide, we just had a carbon price removed. We may yet see it again, who knows? But certainly, well, in particular, I should mention that the European Union's border adjustment mechanism has just been introduced. That will impose penalties on companies, on countries exporting to the EU that don't have some kind of carbon price. That already appears to be attracting the attention of tax authorities in countries like China, which are moving gradually towards carbon pricing. What should we think about? Well, I think so far I've talked about tax in the standard way. We should certainly talk about other revenue, fees and charges and income from government enterprises, which historically has been a big deal and is certainly still significant, certainly significant in the context of Queensland, where we have still a large share of publicly owned assets in things like electricity. Tax expenditures, which I'll come to, which is one area where Australia is active in the tax system and which somewhat undercuts the idea of Australia of being presented here as a low tax country. We tend to do things, we tend to use the power to tax in ways that don't show up in tax revenue. Importantly, we need to look at the tax transfer system as a whole, and just hopping back to what I was listening into in the previous talk. It'll be desirable, I haven't done this here, to look at what Jacob Hacker calls pre-distribution and redistribution. So pre-distribution are all the things that the state does in setting property rights, setting up economic institutions, wage setting and so forth, that affect the distribution of income that presents itself to the tax transfer system, and redistribution is what we do with that. So we'll talk about tax expenditures. Those are important concessions for some kinds of income and expenditure. So superannuation, a huge amount of stuff here. For companies, the superannuation guarantee levy, which effectively makes it compulsory for companies to pay tax, or they can avoid the levy. And for high income earners, individual income earners, there's similarly a health insurance levy, which serves the same function. That if you have a high income and don't buy income tax, don't buy health insurance, you pay an amount to the government, which is more or less as much as the health insurance would have cost. So no one does that. Everyone in that income bracket joins the gets that health insurance. That effectively is the same as if the government had an income tax surcharge on high income earners and used it to support health insurance. Similarly, there's a discount on capital gains, which also tends to encourage the great Australian hobby of speculation in housing. Then there are a bunch of exemptions on the expenditure side, things that would fall into a broad-based consumption tax, but don't. Food, rent, health and education are among the biggest and most significant. So Australia's a relatively enthusiastic user of tax expenditures. That means that the role of the state and the role of the state's coercive power in driving what we spend and what we spend and what we consume is greater than it might seem from the numbers on the tax share of GDP. So now, how to think about tax and public expenditure, and economists have their own way of doing this. The typical version is something called efficiency and equity. So this is what I've called the market liberal or neoliberal approach to economic policy, more broadly shared, I guess. The alternative, which is derived from utilitarianism, is based on what's called optimal tax theory. So I'll talk about these and how they are and aren't problematic. I think certainly the efficiency equity way of talking about things is highly problematic. So efficiency, if you don't widely use in economics, it's what's called a persuasive definition. That is, it uses favourable connotations of a word that actually means something else. And it incorporates an implied model or analysis. So when we talk about efficiency, we might talk about the efficiency of an engine. That's how well it turns input energy into whatever service we provide. The link between that and efficiency as economists use it, is very tenuous indeed. Roughly speaking, an economic policy is efficient if it increases aggregate wealth. Now, this can be backed up by an implicit analysis, the so-called Kaldor-Hicks criterion. Suppose that you do something You change some policy. A typical version would be removing a tariff on imports. That will make some people worse off and some people better off, but under a standard economic analysis, the winners could in principle compensate the losers. If you say this in relation to tariff policy, we ask, well, how could we do this? Obviously, the winners aren't going to just give their gains away to the losers through some kind of personal transfer, but we could in principle use the tax transfer system to do this. But of course, once you apply this to the tax transfer system itself, the whole principle is, in my view, nonsensical. That is, if we're going to tax the poor, going to increase the tax burden on the poor or reduce the transfers and make the rich better off, that's the end of it. There's no second stage by which the rich can give back their gains to the poor. So I find efficiency arguments in general fairly unpersuasive. You can certainly, I suppose, look at unless the distributional effects are neutral, or unless you can actually package things up in such a way, that the distributional effects are neutral or positive. So another word that appears in the literature, not quite as much as it used to, I think, so-called distortions, and this is starting from an idealised market equilibrium, the most efficient tax is one that doesn't change behaviour. Changes in behaviour are often called distortions. Again, obviously a persuasive definition that implies that the market outcome is the natural one. Nonetheless, you certainly, there are some kinds of responses to taxes you don't want. You don't want people, ideally, to put a lot of effort into avoiding and dodging taxes. So I don't want to dismiss this idea entirely. Nonetheless, it's important to realise that these terms appear in the literature over and over again. And as they say in The Princess Bride, they don't mean what people using it think it means. So the most important example of this is taxes, transfers and walk incentives. Labour income taxes reduce the net return from paid work. That gives an incentive to increase leisure or non-market work. So, so if I'm paying 50 cents on the dollar on my marginal income at work, I might decide to do my own lawn mowing rather than paying somebody else to mow the lawn because I'm paying out of my post-tax income what I save. But it's important when we look at this, it is a real phenomenon. Here is where the issue of looking at the entire tax transfer system is important. Australia has highly means-tested welfare payments, so nearly all welfare payments are subject to an income test, which means that beyond a certain threshold, any income you get, any additional income you get leads to a reduction in your benefits. If you add marginal rate of income tax to the so-called clawback rate, you end up with the conclusion the effective marginal tax rate is highest for low-income families. Most welfare benefits go to for income-earning households go to families. That is, single individuals pretty much pay what it says on the label, and it's families, and in particular, in a typical family structure, second earners, who are most commonly women, are paying this very high marginal rate of tax on everything that's earned. It's this rate when we look at worrying about the how much the tax system affects incentives. It's this rate you should be looking at, and essentially you can dismiss from consideration anybody who focuses on the top marginal rate of taxation, because that rate is at a level where nearly all of these concessional benefits have been reduced to zero, so that somebody who's on the top marginal tax rate has almost certainly their effective marginal tax rate, and it's well below the effective marginal tax rate of low and middle income households. So also, taxes on capital income tend to discourage saving. As I mentioned, a tax on labour income is in principle equivalent to a consumption tax. On the other hand, taxes on private income, capital income can be used to finance public capital investment, so that the idea that there's this huge distortion that needs to be got rid of, I think is highly problematic. I'm going to have to move on. I'll skip on over these transaction taxes. Here, I think transaction taxes really are bad and should be got rid of, and we should just replace them with some combination of income, wealth, and consumption taxes. So-called lump sum taxes, these are the ones that economists tend to like because they don't affect behaviour in any way. Poll taxes, poll is just a word for head, and so roughly means if you have a head, you pay the tax an equal amount. Of course, you can't do much without a head, so that's straightforward. But obviously, these taxes are highly regressive. Poor people pay as much as rich. The attempt to introduce a poll tax by the Thatcher government was one of the leading factors bringing down the unregretted demise of that government. Land taxes, on the other hand, again, land is immovable. If you tax land, it can't go somewhere else. So a tax on the unimproved value of land is in general one of the few progressive taxes that economists across the board really like. So they have similar efficiency effects, but radically different equity effects. But of course, both are highly unpopular with those who pay. I just saw a very silly statement from Bevan Shields, editor of the Sydney Morning Herald, about Queensland's attempts to close some loopholes in this tax. And undoubtedly, he was reflecting the views of the property owning classes of Sydney with whom he moves. Finally, there's corrective taxes, which we talked about a bit. I'll skip past it since we're running low on time. These corrective taxes fix externalities. That is, people are doing stuff for which they're not paying, putting carbon dioxide in the atmosphere. The aim is to make them pay for it in a way they would if property rights were properly defined. So now on to equity. It's a vague and unsatisfactory term, and I guess the previous discussion illustrated that we have vague and unsatisfactory intuitions about what's fair and equitable, and so that tends to be reflected in our discussions on this issue. The typical economic terms here: vertical, horizontal, process, and historical. I'll just go through this. So vertical is the one which egalitarians think about. Basically, some combination of capacity to pay or harm done by imposing the tax. So-called progressive, regressive, and proportional taxes. Technically, progressive just means if a portion of tax is increasing, declining, or constant as income increases. But obviously, this is drawing on the generally positive implications of the word progressive in a way that is in many ways just as illegitimate as the term efficiency. So, in particular, if we think of defining expenditures in that way, the logical implication will be expenditures which mainly benefit the rich are progressive, increasing in their income. We tend not to use that term. So it's well established, and I'm going to stick with it, but it's important to be aware that we can't smuggle in progressive equals good. We have to have that justified independently by reasoning, for example, of a utilitarian kind. Horizontal equity means people in similar situations should be treated or taxed similarly. The question is, well, who is similar? Should at one level, all individuals should be treated separately, so that each member of a couple should be treated the same as a single individual, against that view that, well, a single individual or a single parent is going to face significant costs which can be shared by the couple. These kinds of issues remain largely unresolved, but it does imply that special treatment needs special justification. So if we just go ahead and say Queenslanders are going to pay less income tax than people in New South Wales and Victoria, the question is, well, what justifies this? In our current tax code, people in North Queensland and other places do indeed pay less, and the theory, which I'm coming from North Queensland right now as it happens, the theory is that the remoteness and isolation of these parts justifies this benefit. That was probably true 50 years ago. I think quite a bit less so today, as you can see from how easily I can communicate with you and how little effort it would take me to get down to Melbourne if I'd chosen to come in person. Process equity. This is a more, one where we get more in the territory of the lawyers and we have to skip over it pretty fast. But there are issues of clarity, certainty, and due process. Now, these can often be in conflict. We have a large industry of lawyers trying to find loopholes, and the simplest way of fixing those loopholes is for the government to announce, as of today, that loophole is closed. We'll be introducing the necessary legislation down the track, but you can forget about this one. That gives, if the government adopts that as a standing policy, along with catch-all anti-avoidance provisions, you get certainty. That is, you can pretty well say, if this is done effectively, that the tax you pay is the tax that the government set out in its schedule, and that if they made any mistakes, those mistakes will be fixed. Of course, that means that that doesn't give you a version of due process which says, well, if the government made a mistake, you're entitled to cash in. That was a huge debate in the 70s and 80s. I think largely, as I say, resolved in favour of certainty, and indeed the very fact of anti-avoidance illustrates this, that in the 70s, avoidance was being used positively to refer as opposed to evasion. So as long as it was within the law on some interpretation, it was avoidance and was okay, and otherwise it was only if you broke the law, and indeed could be caught and proved to break the law, there was evasion. We now have, of course, a new euphemism, which is minimisation or effective tax planning or something of this kind, but the fact that avoidance has ceased to be a defensible term indicates, I think, that certainty has prevailed as the view that loopholes are going to be closed, and that's what there is to it. Historical equity says long-standing arrangements should be changed. We see grandfather clauses that basically say, even if you made a transaction that produces income in the future, if you expect it to be untaxed, you shouldn't pay tax. We saw that with attempts to fix superannuation concessions and the like. So, optimal tax theory. So these are all ways in which one part of the tax literature works. Most of the tax specialists, theorists, Perm on one, tend to try and want to fit this into a general framework of welfare economics, as we call it. And the obvious version is an idea of the social good, where we say, well, what will produce the best consequences? And I mean, economists are almost uniformly consequentialist in the way they think about things. There's a very little interest in virtue ethics and things of that kind. And our version of consequentialism is usually, though not always, utilitarian. We can tweak utilitarian in various ways, but what economists tend to want is a system that produces the best consequences, the best social outcomes. So the key idea is taxation is costly. We start with this market distribution of income. We might have been able to tweak that in the past, but once it's presented to us, it's costly to collect tax, both because we have to actually go out and send people to get the money, and because people will change their behaviour. On the other hand, we start with the assumption that the underlying progressive tax, that extra income for high-income people is less valuable than extra income for low-income people, and on the standard measures, standard ways in which economists think about things, this is true to an extreme extent. That essentially, on the standard economic model, if we took $1 million from, shall we say, Kerry Packer, like Kerry Packer, James Packer, and we managed to give $1,000 to a poor person, that will be a welfare improving transaction. So for people at the top of the income distribution, really we want to extract the maximum amount of tax possible until they reach the point on the top of the so-called Laffer curve, where they actually start reducing their income to avoid tax. As I say, this is another version of efficiency and equity, but at least in theoretical terms, a lot more rigorous, and as I say, much more radical policy implications. That on any plausible account, utilitarian account of welfare, additional income to high income earners, to very high income earners, is essentially socially neutral, unless it produces good outcomes for other people, and of course socially harmful if it gives those people power to produce bad outcomes. I'll skip over, since I'm running a bit low on time, just assume we know this. Top marginal income tax rate, or our top marginal income tax transfer rate, typically comes out at 70%. We had, at least officially, top rates at this level for much of the post-war period. There was a lot of tax avoidance going on then, so probably the effective rate was lower, but it was almost certainly up around this level. I've certainly paid the 60% rate of my time with no opportunity to really minimise that rate. And as I've mentioned, effective marginal tax rates are still quite close to this level. Concern about so-called poverty traps can be translated as saying the effective marginal tax rate is at or close to that maximum level. Now, I've just got time to talk about the Australian debate on tax reform. One of my favourite persuasive definitions, reform, meant to change in form. Most reforms we've seen in the last 30 years consisted of undoing the reforms of the previous 30, and hopefully we'll see more reforms, repealing most of those reforms before I leave the scene. In the Australian context, reform usually refers to shift from income to consumption taxes and flatter tax scales. Reform has changed, but not necessarily for the better. Whenever possible, I use it unironically, but with an asterisk to indicate this. So where can we go, though? That's what I think about it. First point is a lot of talk about changing the GST. That isn't possible. In order to get the GST through, John Howard tied things up so tightly that it requires the consent of both houses, not only of both houses of Parliament, but of all of the states. In principle, he could repeal the part requiring the state's consent and collect the tax, but I think the idea of getting that through any Senate that's likely to exist at any time is essentially zero, and the idea of getting 8 state and territory governments all to agree to a increase in the GST would be ludicrous in advance, even if they weren't already anticipating that money would have to be divided up and making non-negotiable and inconsistent demands as to what share their own state should get. We could remove GST exemptions for food. That would be a terrible thing to do. One of my few policy successes in a long career was keeping the GST off food. States, far from wanting a flat tax, we really need more progressive tax. And so statutory tax reform we could do is for the government finally to develop some coverage and dump the statutory tax cuts. Most beneficial reforms, Labor advanced a bunch of them in 2019 and isn't going to touch them again for a long time. So at least until we get a Greens government, I think most reforms we could possibly get are off the table. The only one that isn't implicated here probably is land tax. We are seeing gradual move to expand the role of land tax, which might finally get somewhere, but I don't have great hopes. I suppose coming up, economists have a lot to say about tax policy. I don't want to hear it. That's probably because the voting public doesn't want to hear it either. But and also because a lot of it is wrong and we don't agree among ourselves. So I think I've used up my time. I'd be happy to take questions.
Great, thanks, John. So we had in the program that we'd take lunch now, but we might just take 10 minutes for questions for John, because I'm sure you guys have questions. And then we'll wrap it up at 10:02.
John, great presentation, including the obligatory correction of dodgy international comparisons at the beginning. My question is, it goes to partly to the tax mix issue. A lot of economists argue that shifting the mix away from income towards consumption would boost saving, investment and workforce participation. What's your view on that? Is there any evidence here or overseas that that is the case? And secondly, this is a Dorothy Dixer really. What do you think are the key changes to the tax system that would improve our economic development, which is another word for economic efficiency, but expressing it a little more broadly, given your the points you made in your presentation?
Yeah. So there's not a lot of evidence that that shifting more towards direct taxes has much more effect on labour market participation, or rather that shifting away from direct taxes would have this effect. So the countries with a high share of indirect tax include European countries, but that's not because they have low tax on income, it's because they have high taxes all over. And a lot of them have high participation rates. When you look at participation rates, a lot of it's much more affected by things like childcare, and much more affected by what happens to women's participation. And that in turn is much more driven by the tax transfer system, by effective marginal tax rates on particularly income of mothers, than it is by an imagined tax system where the typical tax system, the typical person making these marginal decisions is, shall we say, a professor of economics on the top marginal tax rate. That seems to, in some senses, is the starting point for the model, but of course, any discussion of the tax system which doesn't take account of the fact that people live in families is off being right from the start. I think we can make some improvements in the tax system, but really I think most of the action has to be on the expenditure side. We need more public expenditure on various desirable forms of social infrastructure in particular, and of course we need investment in the energy transition. In this context, things like carbon pricing are really there to get the incentives right, not to provide the revenue to fund public action. And indeed, the government got it exactly right in making the whole thing revenue neutral, giving the money back to low income earners. I mean, pity that the government was dysfunctional in other ways, because that was a great policy which would have been the end of the world had we managed to stick to it.
So we've got a question from Tom in the room, and then I can see we've got Emily online and got a few more in the corner. So let's keep our questions brief and to the point. Thanks, Tom.
Great. Hi, John. Tom Walker from Think Forward. Thank you for the presentation. I think we're planning to embark on a campaign around the intergenerational advantage of the tax system, particularly around the injustice that we see in terms of those tax expenditures you talked about that typically flow to older, wealthier Australians, which means they pay less tax than younger people who rely on working. I guess from your perspective, is that a good argument that is unjust? Or is there a good reason that those tax expenditures exist? So negative gearing, capital gains concessions, tax-free super income.
Sure. Yeah. So in general, I dislike intergenerational arguments. I mean, I think the real inequity is between high income old people and lower income old people.
Yeah.
When you look at when you look at even things like home ownership, what you see is that the people in the top 50% of the income distribution still buy houses at much the same age as they used to, because the bank of mum and dad supplies them. And so the tax concessions we give to high income older Australians on one flow through to the children of those high income older Australians. So I'm although rhetorically that line has a lot of impact, but really the important inequities are essentially class rather than age, and that's true of the superannuation concession. I mean, the concessions are unjustified, but the biggest impact is on other older Australians, but also the fact that those concessions take away money that could be used to support low income Australians in general, of whatever age.
Thanks, John. We might go to Emily online with your question.
Thanks, John. Great presentation. Just was interested in your point around direct taxes not impacting participation, and interested on your perspective as to whether or not increasing direct taxes like income tax for high earners would be a good proposition, because that seems to have disappeared as something that we should be arguing for.
Sure. Well, I mean, as I say, high income earners face at least within the category of families with children, the lowest marginal tax rates are faced by those on high incomes, especially given the many opportunities for minimisation / avoidance most of them have. So yeah, that I think is a no-brainer. That if you wanted a nice simple reform that could be done overnight, it will be to cancel the statutory tax rates. And a second one would be to take the mirror image of those tax cuts and slap it on top.
If only it was so simple.
Yes. Well,
yeah.
simple but not easy. Yeah, like Ronald Reagan said.
That's right. Yeah, that's right. So, yep.
Thanks, John, for your presentation. And you talked about just the political difficulty of achieving tax changes or tax reform. Do you have a view on whether it's more effective to sort of chisel away at individual taxes like capital gains tax, or whether there's more scope to advocate for a comprehensive package of tax reform where you can more easily compensate losers and, you know, and so on?
I think it's entirely contingent. I think if Bill Shorten was a little bit more likeable, or if various people in Queensland hadn't made a mess of things, we would probably have seen a Labor government in 2019 with a progressive program. So I think I'm not a politician, but I don't think there's any way in which you can say this is the right strategy. As I say, the cleverest piece of legal strategy in this process was, the cleverest strategy was Paul Keating's, which ended up getting pretty much the reverse of the outcome he wanted. Arguably, the second cleverest was Houston's Fight Back, which also came a cropper. Howard just managed, and again, contingency is if Howard lost the 1998 election on the two-party preferred vote, just happened to get the votes in the right place. If that hadn't happened, we might not have a GST. So my view is I leave that to the politicians. All I can do is support those who support a more progressive tax system, which is basically the Greens and a couple of the independents.
Josie?
Hi, John. Josie from Oxfam Australia. I was curious to get your perspective on what you think is the most effective way to tax wealth, high wealth, whether it's through things like wealth taxes and inheritance taxes, or whether it's through cutting concessions like super or capital gains concession and things like that.
Well, again, it depends on the politics. I think wealth taxes are problematic, and no one's really made one work very, very effectively. So I would put that on the back burner given the other options. Inheritance taxes are a great option, but I think if I were looking for a big bang reform, it would be to not to have a separate inheritance tax, but to have a tax on inheritances and in vivo transfers, that is bank of mum and dad stuff, and treat that as ordinary income. That will be a radical change which would really have a big impact. If I'm looking for something, I think on super, what we see, we saw a bunch of giveaways from Labor in the 1980s trying to get the thing through as part of the Accord. That was clawed back and clawed back. At his parting gift to us, Peter Costello stuck in a whole bunch more concessions, and governments of both colours since then have been trying to claw that back. I would guess in some sense the political process is doing what it can in that respect. Everybody knows these concessions are way too generous, and every now and then they get, and even this Labor government has, I think, managed some kind of chipping away at the excess there. So that's sort of I think the one where the right kind of push might make a difference is land tax. We've seen a variety of people go for it. It's a really great tax, and in particular the ACT government, having the marvellous fact that it's a territory government as well as a local government, has effectively used the rate system as a land tax. So that would, I guess, be, if you're looking for a background route to it, it would be to integrate the state tax system with local rates, and then raise that enough to deliver substantial revenue.
Thanks, John. I think, Chris, you had one more question.
I'm guessing, sorry, Chris Black from BSL. I'm guessing that part of this whole project is about how we get an understanding of all this out into the public more generally. I'm just interested, John, in your thoughts on why, I mean, the high effective marginal tax rates that we always hear about, you know, particularly hitting women and low income earners, it's just never part of the public discussion. Whenever we get into talking about tax, we're always talking, you know, the loudest voices are those probably least affected, but with the most to gain. I'm just wondering if you've got any thoughts on how we can, renaming EMTR would be a good start, but other thoughts about how we can get that voice stronger.
I mean, of course, I mean, a looser, more remote term is poverty traps, but that's kind of problematic because we're not really, you know, I mean, there are poverty traps in there, but saying, you know, a working class family, you know, shall we say, fitter and turner shop assistant facing a poverty trap isn't going to sell very well. I think, you know, even though they're facing this very high rate of marginal taxation. I mean, I think what we can say is much more than in lots of other places, this point is understood within the policy, the political class, at least the tax policy class. So in a lot of places, I think people in Treasury don't really understand these things. And in Australia, at least, I think the people who know what they're talking about know all this. I don't have any good ideas beyond I try and shout as loudly as I can in every venue open to me, and would urge everybody else to do the same.
Well, on that note, we might. Oh, we've got one more question. Okay, one quick one, Mark. Yep.
Quick one. Hi, John. Mark Jones, Tax Justice Network Australia. Just you said transactional taxes were bad. I'm just interested in your view on a Tobin tax.
Oh, sure. I should say, okay. Transaction taxes are bad on the assumption that the transactions are good. So the ideal Tobin tax will collect no revenue. It would just drastically reduce. It's essentially a sin tax like taxes on tobacco, which we discussed last time. The idea isn't to say, look at all these international transactions going on. Let's look at all the money we could raise. It's these massive amounts of transactions are destabilising the global economy, prioritising speculation ahead of productive investment. If we tax them a little bit, the volume of transactions would fall drastically, and we would have a little bit of money left over. But the point of a Tobin tax is not to raise revenue, but to discourage the activity that's being specialised. If we're talking about people moving house or taking out an insurance policy, there's no sense at all in which we want to discourage those things. All we have is a survival of 18th century models where the government acts as a ticket clipper. Even the very notion of a stamp goes back to the Stamp Act that caused the American Revolution and so forth. So I think taxes on bad transactions is good. If we could find some way of taxing gambling that didn't harm gamblers as much as our existing taxes do, that would be good. But we don't want people to be unable to sell their house, to move house, and we don't want people to face penalties for taking out insurance. And so taxing those things through stamp tax is a bad idea.
Hey, all right. Well, can you all join with me for thanking John for his... Thanks, John, for a terrific presentation where you covered a whole gamut of topics and issues so clearly. So really appreciate your time.
Thanks for having me.
Thanks, John. So our last two speakers are kind of rounding out our discussion of tax policy. Jason Nasios from the Centre of Policy Studies at Victoria University is an expert in mathematical modelling and has expertise and heads their fiscal modelling or tax modelling team. And so he's kindly agreed to speak to you about how economists go about modelling the assumed behavioural effects of tax. Because as we know, that's something, kind of discussions around the efficiency costs or the distortions of tax, which both John and Dan mentioned, are a large part of the tax debate. So getting some sense for how models actually give a voice to this and give a picture to this is very useful from an advocacy point of view. So thanks so much to Jason for coming along and agreeing to speak today. So I'll hand it over to you.
Great. Thanks, Catherine. All right. Thanks very much for the invitation to speak today. I really appreciate it. And thanks everyone for coming along. The advantage of speaking in an audience such as this is that everyone's come along understanding that I'm going to be speaking about tax, right? So the notion doesn't scare anyone away, right? Which it does from time to time. So thanks everyone for coming. I'm going to cover off a couple of key kind of ideas. So firstly, I'm going to motivate and introduce the kind of economic model that we typically use to answer questions like how impactful or how distortionary is this tax relative to another? What would the impact of tax change, reducing tax rate X and increasing tax rate Y be? Right, so I'm going to talk about that class of models that we at the Centre of Policy Studies have been developing for, not me personally, about 50 years, me personally for the last 8 or so, but I'll be talking about those in general, and I'll be answering a couple of key questions. So certainly I'll get through the answer to the following question, which is, why do these models typically disagree from time to time, right? So I'll home in on a very specific policy example and try to unpack why models may disagree. And then time permitting, I'll answer 2 other questions. The first of those will be where have these models, where have the outputs of these models kind of stopped in the past? Where's the analysis stopped? And is that suitable for informing the public policy debate as it is, right? And where can we go from here on, right? I'll try to fill in some of those blanks that we haven't covered so far, right? In the policy debate, perhaps up to about 2020, right? So that's kind of the idea of my presentation today. Okay, so the style of modelling that we're going to talk about. So I had to do a lot of reading when I started at COPS about tax policy. Some of it was recent, some of it was old, right? So when we're talking about tax distortions and economic analysis of them, it turns out to be a lot falls down to geometry, right? And the so-called Arnold Harburger triangles, right? So measuring how big the distortions caused by certain taxes are relative to the revenues they raise, right? So a lot of the core reading I went back to was actually Harburger's work on the topic, right back to 1962. In 2008, he was still publishing. So one of his key kind of papers in this whole area was to do with corporate income taxation, and he revisited this topic in 2008, and this is what he had to say about it. So typically what he's found is when somebody goes about trying to look at a particular tax and how distortionary or how damaging it may be, they build a very specific model of that particular tax. They identify the agents that tax impacts, the agents who are shielded from that tax. And then they go about trying to change its rate or remove these exemptions and study what the net impact on some kind of notional measure of welfare is, right? The idea he had and expressed here was, instead of building many, many small models, the tax system's actually massive, right? We have so many differentiated goods, so many differentiated producers. Why don't we try to build a model that understands how these guys all link together, right? And those kinds of models are called computable general equilibrium models. That's the kind of model I'm going to talk about today. And it turns out that in 2008, he hadn't seen much in the way of computable general equilibrium models used to analyse kind of economy-wide changes in taxation. That's what he's getting at here. So that's what we're going to talk about today. And why is this kind of important? Well, in Australia, we actually have a rich history in CGE modelling, dating right back to the 1960s, 1970s, and a lot of the debate with regard to the reduction in Australia's very high import tariffs. That's kind of the genesis of the whole thing in the Industries Assistance Commission, which is now the Productivity Commission. That's where COPS, the Centre of Policy Studies that I work for, was actually founded, and then we spun out into the public sector universities from there, right? But one of the big debates with these models in Australia, particularly around 2016, 17, 18, was to do with corporate income taxation and an analysis of how damaging this particular tax was. Now, in order to benchmark taxes, we typically, like I said, try to measure the damage each tax causes to welfare relative to the revenue it raises. I'll define this algebraically, moving on in a very simple way. But basically that measure, the ratio of change in welfare to change in revenue, can be thought of as the marginal excess burden if we put a minus sign out the front, right? Taxes that are bad, which is, or taxes that cause economic distortions, because we've got a minus sign there, have marginal excess burdens that are positive. Right, so typically we'd expect most taxes to have positive marginal excess burdens. So in an analysis in 2015, Federal Treasury looked at corporate income taxation and they used the CGE model and they found the marginal excess burden to be about 42 cents per dollar of revenue raised. That means in excess of the dollar of revenue we've raised, we've caused 42 cents of economic damage to welfare, right? Now, we went and looked at the same kind of question. We asked, how damaging is corporate income taxation in Australia at a time when corporate income tax cuts were on the policy agenda? And we came up with not a smaller positive number, but actually a negative number, right? So not only did we differ in order of magnitude, we differed, in sign, right? Using similar modelling frameworks, computable general equilibrium models. When you see things like this in the public, you kind of begin to distrust modelers, right? So one of the burdens of proof or the questions we were asked was to begin to unpack this, right? And so we did. And what I'm going to try to get across today is that the devil in all these models is always in the detail, right? CGE models are massive. Hundreds of industries, potentially hundreds of regions. That means many households, right? And all of these guys are linked. They're suppliers of factors of production like labour, suppliers of funds to finance capital investment. Understanding, where models differ in that representation of the economy or that detail actually gets at why these numbers are different. So I'm going to try to unpack that today, hopefully rebuild some trust.
Can I just ask you before you go on?
Yeah.
So the positive 50 or 42, those two estimates.
Yeah.
Imply a burden, that is that it's
that's correct.
Bad, distortive, if you accept.
That's right.
The negative number, which is the number COPS found.
That's right.
Modelling
implies a benefit.
Positive for the economy.
Yeah.
Corporate income tax is actually good for the economy, not bad for the economy. Right. So that's the positive and the negative. It really matters a lot for the policy reform story, which number you believe.
That's right.
Right. Which number is it economically distortive and therefore bad, meaning you've got a positive number in this framework, or is it economically positive as well as raising revenue, right? It's not about the revenue, it's about the economic effect of the tax.
That's
sorry
exactly
to jump in. Is that all?
No, that's fine. Yeah, that's fine. Yep. So that's what I'm going to try and get at today. So this kind of says what I've just said. So I'm going to introduce at hopefully a high level, because I don't want to go into too much detail about what a CGE model is. But I'm basically going to reinforce the messages I've already kind of put out there, that there's a lot of detail in these models and why that could be useful. And then I'm going to go back to the Henry Review and also Treasury's review, because they use similar modelling frameworks to try to understand the breadth of those reviews into Australia's tax system, understand how broad they were and how they compared to our work, our most recent work, right? And then we're going to explain some of the differences in detail. Okay, so let's go to an exceedingly simple model of the economy, right? So we have one. Let's boil all the industries down, join them all together, a single supplier of goods, right? They have an upward sloping supply schedule. Why is it upward sloping? Well, as the price along the y-axis goes up, that incentivizes them to increase their output. That's the x-axis quantity, Q. We have aggregated all the demanders together. So all the differentiated households, they're all just one household. They're bundled together with the public sector. They're bundled together with all the demanders of Australian exports, right? And they all we're just going to call them D, right? They have a downward sloping demand schedule. As the price goes up, they demand less, right? Somewhere where the supply and the demand curve join or meet, We have aggregate output, so the quantity of output we make, and the aggregate price level we sell it for, P. Okay, why is this exceedingly simple? Well, firstly, we've made no mention of time at all, right? Time's a very real variable that we all experience, right? Why is time important? Well, if I'm an industry like the mining sector, right, demanding a lot of heavy machinery, specialised equipment, in the very short run, right, I find it difficult to respond to changes in world prices, right? So my supply schedule mightn't look like this, but if you flick one forward, it might look like this, right? So even if the price went up heaps, I couldn't expand output very much. All I'm going to experience are windfall profits, right? Because I was quite happy selling at lower prices before, right? But if world demand shifts out, right, all I'm now going to experience is windfall profits, right? So time's important because some industries may look like this in the short run, but in the long run, they can actually change. They can begin to invest, they can bring in more heavy machinery, respond to short run changes in price and increase output, right? So time's really important. It's a variable that wasn't present in Treasury studies of this particular corporate tax scenario, right? So just keep that in the back of your mind. What else is a problem in this very simple view of the economy? Are all producers equal? Well, no. So if we flick one more forward again, you may have some producers that look like the very constrained short-run mineral and resource industry that I had before, that really kind of steep supply curve. Whereas some industries may be labour-intensive, right? They could suck in unemployed workers in the short run as demand for their services rose, right? So having some kind of industry disaggregation or industry detail can be really important in telling a story, right? So there's another piece of detail that the exceedingly simple model of the economy lacks, right? Where else could we add in some more detail? Maybe if we move on forward, could be in the demanders, right? So the public sector is really different from even one aggregate household, which is really different across all the households, households in different regions, or even households across the income distribution, right? So if we go one more forward again, you may have some households or some demanders for Australian output that have really kind of flat demand curves. So they're kind of willing to pay some kind of notional world price that Australia can't change too much. And all that's really constraining us from expanding output is our capacity to actually bring in the machinery and make more stuff, right? So that's that kind of lower right-hand angle there, that lower right-hand figure there, right? Whereas we may have some demanders that are more constrained than that, right, and more price sensitive than that. Perhaps this is households, right, and their choice to consume insurance services or not. So there's another piece of detail that's lacking. So we've got time's an important variable. Ideally, we'd have lots of industries because their production structures may be different. Ideally, we'd like lots of demanders, right? Because that tells us the sales structure for each industry and whether they can expand output really easily without much change in price. So time, cost structure, sales structure, all important variables not in our key model. If we flip forward a bit more, I haven't even begun to talk about taxes. I haven't even begun to talk about retail margins, right? Think about how you consume fruit and vegetables. You don't go out to the farmer. You actually go to Coles, Woolworths, your local fruit grocer, who are a retailer, who purchase it perhaps from wholesaler, right? So this whole chain of that functions isn't represented in that exceedingly simple model, right? These are all details that are in CGE models though, right? So you can begin to understand the dimensionality is increasing, a lot here. And if we go one more step further, we've got think about one of the factors of production you may think of kind of naturally, machinery, equipment, land, right? Who owns this, right? That's a really important question, right? Because who owns it actually differs across industries, right? The mining sector is largely foreign owned. The dwelling sector is largely domestically owned, right? Representing that different ownership structure is really important to understanding income impacts of tax change, right? Because tax change doesn't impact all owners of capital equally, Often it differs. And so that means that there's important implications to national income that can only be tracked with a model that understands where foreign and local capital ownership is concentrated. That's another really important dimension. And with these frameworks, if you can put that kind of detail in place, you can begin to answer questions like this, common reader questions. How much price, how much quantity, right? What about prices of other goods? What about demand for other goods? And then can you unpack that? Why is your result different from theirs, right? That's the kind of thing that we've got in our model, right, in our CG model. Next slide. So I'm going to give a very conceptual sketch here because I think I'm kind of already going a bit over time. So in terms of,
Take your time. I think it's important for people to.
oh, good. Okay. So in terms of our model, think about kind of high level. We've got in our model we've got many regions. So we've got the states and territories. Functionally, that's how we run it at the state and territory level, right? In each state and territory, we identify over 200 industries, right? But we never run it with 200 industries in our model because the computer would take, weeks to solve the model, right? So typically we select industries that are important to answering the kind of questions that we're trying to ask of the model, right? So everything I'm going to speak to you about today has 86 industries distinctly represented in each region of the model, right? They're the industries. And then if we go forward, I talked about cost structure being really important. So in terms of cost structure, what we want to think about are things like machinery and equipment. We're going to call that capital, land, right? Really important in certain industries, particularly housing, right? And then also we've got labour, obviously very important, particularly service industry, also dwelling investment, right? And all of these industries also use imported commodities, right? So they bring in heavy machinery, for example, to produce their output. They're the inputs. That's part of the cost structure. If we go one forward again, in terms of using imported commodities or imported goods, they also use domestically produced goods, right? So they take these factors of production and make stuff. They sell that stuff to each other, right? This is the kind of thing that we're talking about with margins, for example, right? So they sell retail services, wholesale services to each other, insurance services. A lot of insurance in Australia is actually to cover some kind of company or corporate risks, right? So they're all domestically produced commodities. They also sell those to other demanders in Australia, right? Households in our model. And this is one of the points where we talk about, there's kind of like an envelope of things that we focus on. We have a lot of industry detail, right? We don't have as much household detail. There's other economic models that I'm not going to talk about today that put the emphasis on the household detail, right? Here we have 8 regions. We have 1 household in each region, right? And that's useful in answering the kind of questions I'm going to talk about today. But there's other questions that the model isn't set up to answer. So it's important whenever we're reading kind of economic modelling output to understand where that kind of border is, right? Different models are good at answering certain questions. It's really difficult to model everything all at once. We just don't have the computational power. This model, for example, has about 10 million equations, right? 10 million endogenous variables. We're solving it dynamically, so year on year, typically over a 20 or 40-year time horizon to understand short and long-run consequences of policy. It's really big. Takes a long time to solve, right? Adding more detail can, increase that time quite a bit. So we have households, we have an overarching layer of government, the federal government that manage their own balance sheet. We've got state and regional governments that manage their own balance sheets as well. We've got investors who go to work in forming new capital, right? So this is new machinery, new equipment, new structures that industries use to produce their output, but not more land, right? Land's special. And we've got exporters, right? So we have exporters that demand Australian varieties of outputs. And this is the kind of agents that we distinguish in our model. So we've got cost structures. The agents tell us something about the sales structure. And then this is dynamic. So there's time, there's short run and there's long run consequences, right? So that's what we're trying to talk about when we're talking about a CGE model. Lots of industry detail, not as much household detail. Okay, next. All right, so when we're talking about using models with industry detail to study taxes, right? We have to start talking about, we have to come up with a notion of what welfare means in a model like this, right? And that's kind of, you know, somewhat challenging, right? So where do you draw the line? Do you talk about reductions in gambling, for example, as being, you know, in some way beneficial for society? Does that filter into your welfare measure? Do you talk about reductions in the incidence of smoking-related cancers as feeding into your welfare function? It doesn't here, right? So this is, again, another important thing to remember, right? What goes into the cake, right? What goes into the measure of welfare? The ruler can be different, right? And it's important to understand what kind of ruler we're using here. And the ruler, again, comes from Harberger, right? And his notion of national income. So we want to talk about, we've got a system of taxation in place now. We've got an industry structure in place now. How can we make the resources that we've got available to us to produce output work a bit better for us, right? i.e. produce more income for our given endowment of resources. That's the ruler we're using here. That's our welfare metric, right? It's otherwise identical to the welfare metric used by Treasury, right? So it's reasonably common for economists to ignore some of these other issues, which are not unimportant, right? But we're trying to get kind of a very broad measure here. So just bear that in mind. The ruler does differ, right? Next slide. So here's just an algebraic definition of the excess burden you saw before, right? If I would go and change a tax rate, so I'm going to increase the tax rate. In general, I'm going to push up the denominator there. The change in revenue will be positive, right? That's going to go up. If we're talking about most taxes, welfare goes down, right? So the ratio of the change in welfare to the change of revenue is negative. We put a minus sign out the front because positive signs are easier for everyone to look at, and we call it an excess burden, not an excess benefit, right? And typically with that minus sign there, we expect most taxes to produce excess burdens or numbers here that are positive, right? And we want to understand, where do all the taxes rank? We've got a tax system in place. Where do they all rank? Our existing suite of taxes. How distortionary do they look? What are their excess burdens compared to each other? If there's some that are really big and some that are really small, they're ideal candidates for tax mix change, right? So that's what we want to try to look at. So let's go to the next slide. I've kind of said all that. So, all right. So here's where the tax system itself looks like right now, right? So where I've got all the taxes listed down the left-hand side there, right? A lot of Australia's taxes. These are state taxes, right? Here I've got in the second column, I've got revenue to GDP ratios. You can see a lot of these are really small. We call taxes with small revenue to GDP ratios, they're typically narrow-based taxes, right? Because the rates aren't insignificant for a lot of these. For some of the insurance duties, they're 10% of premiums, for example, right? For some of those transfer duties, they're 5% of housing sale prices, right? So they're not insignificant taxes, but they don't raise a lot of revenue to GDP. But some of their excess burdens are huge, right? I haven't ranked this in descending order. We'll see a figure of that in a moment. But it's pretty easy to see that property transfer duties are really distortionary here. That's one of those red arrows. Here we break property transfer duties up into two components. The property transfer duties incident on households transacting residential property, right, between each other. That's the residential component there, 112 cents per dollar of revenue, the most distortionary tax in Australia by far, right? Household transfers of existing residential housing, as distinct from commercial property transfers, which are a little bit less damaging, right? At the lower end of the scale, we've got land taxes, state land tax, local council rates. Here I'm modelling the New South Wales system of local council rates, unimproved land values only. Right? They don't have a positive excess burden, they've actually got a benefit, right? So a negative excess burden. Okay, that's the state taxes. What about if we flick to federal? There's a few here. We don't go across all of them, but you can see we capture a fairly large share of revenue to GDP because we're capturing personal income taxes, which are compared to the other taxes on a revenue to GDP measure. But some standout features, personal income taxes and GDP at their current kind of levels of revenue to GDP are about similar in terms of the economic distortions that they cause. Fuel excise is very, very low. So little arguments in favour of fuel excise cuts, even less if the oil price spikes, because this is a specific tax, right? So it's cents per litre. It's not cents per dollar of fuel purchased, right? So it's a little bit different, right? As the oil price spikes, you still consume the same amount of fuel, right? But the amount you pay, the denominator goes up. So the tax rate, the effective tax rate goes down. It's like a self-cut when the fuel price rises. So little argument in favour of fuel excise cuts. The corporate tax, very, very negative, right? Minus 26 cents. And I mean, there's all kinds of issues that John talked about a little bit here regarding, you know, who's responsible for expenditure, which layer of government's responsible for expenditure, which layer of government raises a lot of revenue. But this kind of picture, with all that detail in place, we can start to benchmark the tax system we've got here. And that's the kind of key message here. We pick one number out of, say, 10 million, right? And we try to use this number to understand where we should first aim our reform agenda, our tax reform agenda, right? We're not talking about taxes we don't have in place. We're talking about the existing system we've got. Where can we begin to make it better, less distortionary, take our existing endowment of resources and use them more efficiently to generate more income and benefit welfare domestically, right? With this in place, if we go to the next slide, you can begin to produce charts like this. This is in descending order, those excess burdens we've just generated, right? And then I've ranked them by, that's the blue line, right? Our existing ones. Then I've taken what was produced in the Henry Review and I've overlaid that. That's the orange line here. So in 10 or so years, we've filled in a lot of the gaps from the Henry Review. You can see it produced some numbers, right? But it was missing a lot of important ones. For example, personal income tax. So the Henry Review estimated a labour tax, but that's not our personal income tax, because part of the personal income tax is incident on capital income. That's a devil in the detail, right? We filled that in. What about some of the other taxes? So you can see the Henry Review produced a number for insurance duties, 67 cents per dollar. Pretty big, right? Insurance duties are quite broad in general. Bundling them together doesn't make a lot of sense. Even if we unpack health insurance levies from life insurance duties and general insurance duties, within the general insurance duty umbrella, there's about 4 or 5 classes of general insurance duties. Right? All of them levied at different rates. All of them carry their own excess burdens. All that detail's here, right? But putting that detail in place is a massive job. Just building this database takes 2 of us at COPS about 2.5 months, right? Just to take the initial snapshot of the economy and put it all in place. It's a big job. And then you can talk about running all the sims. There's probably about at least 100 sims that go into generating this kind of thing. And getting those working takes a bit of time. So it's a big job to produce just this chart. But if we go one forward and have a look at the...
Sorry, I just wanted to check exactly what this is, because I'm finding this one a bit hard to follow. So the red dots are actually what was suggested by the Henry Review or what was implemented?
So when the Henry Review at 2010 sat there and tried to take a snapshot of the tax system and understand which taxes are most damaging and which are least, that's the snapshot it provided. So it gave us, with their model, an assessment of 1, 2, 3, the orange bars, sorry, the orange lines, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and maybe a couple of other taxes, right?
So it says KPMG, but they did the modelling for the Henry.
Yeah, KPMG did the modelling for the Henry Review, right?
Generally good.
So, yeah, 28 minutes.
And
Okay.
this is actually you modelling what actually happened.
No, so there's no modelling of what actually happened. What we did was we built a new snapshot, right? And we filled in a lot of the gaps, right? Because when we're talking about reforming something like the tax system, which is massive and broad, right, and really nuanced in some of the detail, better snapshots, more detailed snapshots, add a richer picture and provide richer policy advice, right? So that was the idea of the blue line here, right? Not only where have we gone since then, because 10 years had passed, that's a big time. And you can see some of the numbers are massively different. Some of that's down to time, right? And then some of it's down to detail. So I'm going to talk first about detail and next about time, right? So that's, yeah.
What is this measuring? So this is measuring like how much tax it raised.
No, it's not
just
revenue, it's efficiency.
Yeah, it's efficiency. So So damage to welfare relative to revenue raised, right? So it's answering the question of, if I want to raise $1 more of revenue, right, how can I raise it most efficiently? You look at this chart, right, and you say, to raise it most efficiently, I want to cause the least damage possible. That means I want the biggest negative number or the smallest positive number from this chart, right? Turns out the corporate income tax is the biggest negative number, right? So raising $1 more of revenue from our figures would suggest bigger corporate income tax, right? That's versus Henry Review, which would suggest, I think, a land tax, perhaps council rates, council rate system, right? Which was just, there was no negatives in that review, right? So let's jump 5 years forward to Federal Treasury's next review. If we go to the next slide, that's what they produced 5 years later, right? So now we've got probably similar council rate numbers. You can see Federal Treasury's updated figures to 2015 had similar excess burdens, now negative, for council rates on an unimproved land value basis to our study, right? So it's come down a bit, more negative. They've now introduced a personal income tax, right? They've scuttled some of the detail on the indirect taxes, these insurance duties and things like that, but still very high number on the corporate income tax, 42, and still a much lower number on transfer duties than our figure on the far left. Nevertheless, it's the biggest, most distortionary tax, debt transfer duties in Federal Treasury's 2015 study, right? But that's what the two questions that arise out of this is, how can we understand these two big differences between our work and another model that's also a CGE model, right? How can we start to restore some confidence in the public, in modelers, right? How can we begin to understand these differences? So this is about unpacking it and understanding what drives your model, right? Millions of equations, what drives this result? So let's go one more forward. So this is what I want to talk about here, right? So Federal Treasury produced numbers like 50 cents. I'm going to look first at corporate tax, right? So in the figure on that I just had, I'm going to look on the far right and try to explain those differences, the corporate income tax excess burden. Why do we produce minus 27 cents, right? And why does Federal Treasury produce 42? That's what we're going to attribute to. Ignore the 50 for the moment, right? 42 is the number we're going to attribute to. Firstly, if we look at this, you can see the green bars, which are our results, have entries in every year, right? Federal Treasury, I've only got one number at the end. That isn't, because I wanted to omit what they put in. It's because they didn't put that detail in, right? So our model's dynamic. So time's a variable here, right? We move from a short-run environment where the shock happens and agents begin to adjust their consumption patterns, their expenditure patterns, to a long-run environment where that adjustment's happened. Federal Treasury jumped straight to the long run. There's no time there, right? So that becomes a little bit important. So if we go to the next slide, right, I want to say that we actually agreed quite a bit with a lot of what Federal Treasury said. Corporate tax cuts will improve employment, right? Will expand employment, more workers, right? Will expand GDP, gross domestic product, the stuff that we make, right? We'll make more and we'll work more, right? We will have higher wages, right? We will have more capital stock. That means higher investment. But how can a policy improve Australian welfare if it decreases household income and national income, right? That was the big predicament. We found national income fell despite all those benefits, higher wages, higher employment, all that. We found income fell. Federal Treasury found it went up, right? So understanding and explaining the differences comes down to explaining that red line. Right.
Just explain again what you mean by national income.
Yeah, that's a good question. So think about labour, right? All the labour income in most CGE models accrues to residents, right? There may be a little bit flowing offshore, but a fair and reasonable representation would be that all falls under the income of the umbrella of national income. We get to keep our wages, whether it flows to the public sector as taxation revenue or households for funding private expenditure. It's national income. Capital income is different, right? Because we have foreign investors. So real national income differs from real GDP insofar as real national income takes account of who gets to keep the income and real GDP takes account of how much income the nation generates. That's the key difference. Where does the income flow? If you can come up with that, you can explain the red line and the black line here, right?
Just on the definition of excess burden.
Yes.
So it seems like, is it an orthodox choice to define welfare as real national income? Or if you define welfare as real GDP, would you end up finding the opposite?
Yes, absolutely, because the real GDP response changes sign. GDP is not a good measure of welfare. There's almost no economist you'd find that thinks GDP is a good measure of welfare, right? What matters is for the nation is how much of the income we get to keep from our endowment, our factors of production, our labour, our hours worked, and the capital that we have deployed.
And I guess, is that like the common choice to use real national income as the numerator for excess burden?
There's other choices. There's things like they're more complicated measures of income. There's equivalent variation, compensate, and we could go on and on, right? The technicalities are kind of neither here nor there. As I'll show, these differences in results don't come down to the choice of welfare metric. They actually come down to details in the modelling. Yeah. So if we go one more slide. Okay, simulation design. So what did we do? So we cut the corporate tax rate a little bit, right? Not very much. Similar to what Treasury did. Cut it a little bit, right? Cut it enough to cost the budget, I think 100 million or so, right? And we implemented the cut in 2019 because we're looking at a policy from a few years back here, right? And then we forecast out what the impact would be in the long run, 2040, right? And then we took our core model, which is the green line that you've been seeing and all the green results, right? And we started to change it. And we started to make it more reflective of assumptions underpinning Treasury, right? So there's a couple, I'm not going to go through all of them here, but there's a few really important ones, right? This one here is really important. In the Federal Treasury study and in our study, there's a similar national foreign ownership of capital share, right? The problem is in the detail. In our model, that foreign capital ownership is concentrated in the mining sector, right? In Treasury's model, it's uniform across all sectors. That means about 30% of the housing stock's foreign owned. And guess what? The housing stock's corporate income tax exempt, right? So that's really important. That's a really critical detail you don't want to miss, right? So we've put that in here. What's another important detail? Well, it's actually what the corporate tax cuts do, right? So think about foreign investors in Australia today. They own about 30% of the capital, right? They willingly invested it at 30%. If we give them a corporate tax cut, we give them a windfall gain on existing investment. What that does is that stimulates GDP because they begin to invest more, put more capital here, stimulates employment. But at national income, there's a bifurcation at the point of the tax cut because we give them a windfall gain. That means a chunk of income under a baseline that was accruing to the public sector now accrues to offshore investors, right? That's money that we would have had that flows out. Okay, so what I want to focus on here are the orange bars in the next slide and the grey bars, right? Or there are other factors at play. But as we begin to change our model to reflect Treasury assumptions, you can see big changes in the short run impacts here. They're the orange bars. What we did there was we grandfathered the tax cuts, right? We said now, because Federal Treasury use a long run comparative static model, so they don't have this dynamic time path where there's short run costs and we have to service those costs over time, right? What we did was we tried to jump more to a long run situation where we grandfather the tax cuts. We don't pass through the short run as we do, right? If you grandfather the tax cuts, there's no offshore transfer to foreign investors in the short run because they're not allowed to claim the lower tax rate yet. They're only allowed to claim the lower tax rate on new investment. What that does is take our green lines and increase them by that orange bar in the short run. Massive impact on national income and excess burden, right? Over time, that starts to filter out as the old capital depreciates away and is replaced by new capital. That starts to filter away, but it never fully disappears, right? It always lives on, right? The other one is the grey bars. That's the impact there on the green bars on our original assumption of a uniform foreign ownership of capital share, right? implemented where 30% of the capital is in the housing sector and that's tax exempt and things like that, right? You can see here, that's a pretty big impact. And there's other really important impacts too, and they're linked, right? This impact is driven in part by the fact that we have foreign ownership in the mining sector that exports all its output, right? That's also a really important detail. But what I want to try to kind of give you some kind of comfort about is that when we try to take account of all these differences between our study and Treasury's, we take our number of minus 27 cents, and if you add all those coloured bars to the green bar, you come up with a figure of 37 cents in the dollar. So we lift it each time we take account of one of the issues that we identified in Treasury's modelling. We start to lift our negative excess burden up much closer to theirs. In total, we attribute about 93% of the difference, just with 6 factors in a model with 10 million variables. That's pretty good. We're understanding pretty well what's driving the policy change, what's driving our results, how our model works, right? And I think if you kind of read our paper, and I think you kind of can come around to the idea that probably minus 27 cents is probably closer to the truth than 42. So that's where we are with that. And I think I'm out of time. So I had some other ideas. I had some other things. If you have questions on some of it, we can kind of touch on it. But that's what I wanted to try to get across. And happy to take any questions.
Great. Thanks so much, Joe.
Do you know, so I have a question.
Wait a minute, Miranda.
Let you do that. Yeah.
That was intense, but really, really useful. Because I think from our perspective, you just see these efficiency costs trotted out, and to get that explanation of the variations that and what they're attributable to is really useful, even if maybe not everyone was across all the technical detail, but I thought you did an amazing job of explaining that technical detail really well. So thank you. So we are a bit over time, but we've got a bit of a buffer at the end of the day through discussion. So I think we'll just take about 10 minutes or so of questions. So Miranda has a question. Does anyone else? Toby?
So I don't want to dominate, but I did want to ask you, you guys have been talking to Treasury, obviously. So this is really important because this stuff goes into the efficiency analysis of taxes. That's kind of what this is. And those different numbers have driven a lot of policy recommendations, not always a lot of actual change necessarily, because we know reform doesn't always happen, change doesn't always happen. But has Treasury responded to your, I mean, you could call it a critique, or you could just say we've done this more detail in the factors and so on, and we've kind of improved. We have a lot of similar assumptions. This explains our difference. Our way is better because of these reasons, right? Presumably that's what you're saying to Treasury.
Yeah, well, I think since this, Treasury's embarked on a program of model development work. So they're now developed a dynamic model. I think they're now very much on board with the fact that inhomogeneous foreign capital ownership shares across industry is very important. I think their understanding of the fact that that purple bar is driven by how sensitive foreigners are to the domestic output price in Australia of what we produce. I think Treasury's numbers previously for that were completely unrealistic and non-reflective of any global trade model in existence. More reflective of typical textbook style small country economic models. So I think all of these changes, at least the purple bars, the grey bars and the orange bars, have been made in Treasury's modelling. And there's probably other small effects at play, but I think I picked one of them there just to illustrate that there's things that aren't important as well. This is kind of the lime green number. But yes, Treasury's, I mean, we've had discussions with them on this front. I think we've had good progress in that. And I think I spoke to Catherine before I gave this talk to understand what you might like to hear about. This is an example of modelling that impacted policy, right? Because the corporate tax cuts, Enterprise Tax Plan 1 and 2, they were kind of ready to go, right? And then as part of an exercise for an economic forum, we were asked to independently assess with our model what a corporate tax cut would mean for Australia. When we embarked on it, we thought, generally it would probably be okay. But then the model remembers things that we didn't, and this is what it remembered, right? And when we went to work trying to understand why our result differed from Treasury, we unpacked it with those kind of coloured bars there. And Enterprise Tax Plan number 2, after my colleague Janine Dixon presented at Senate inquiries on the topic, presented to senators on the topic, it ended up being scuttled as a policy. So this is kind of, I think, good work in action, right? In the sense that we had independent assessment of a policy that was put forward. We came up with very different numbers. We were asked to explain why we did, right? And people believe that story. So I think it's an example of where detail's good, as well as where it needs to be placed a bit more emphasis on.
We'll go to Toby next. It's probably just worth me just stepping in at this stage just to clarify something. So if we go back to Dan's presentation when we're talking about all our different theories, here we're most squarely within a version of utilitarianism, which is what's represented by welfare. And as Jason intimated, like what counts as welfare is really contested. It could be very simply measured by just like your consumption preferences or much more detailed. So we're talking about a version of utilitarianism here, and all we're talking about is efficiency. We're not talking about equity. We're not talking about redistribution. We're purely talking about efficiency. But as you know, it really drives so much of the tax debate. So I just thought I'd just clarify that before we go to our next question, which is Toby.
Thanks. Jason, a couple of questions. The first one is just wondering whether tax expenditures feature in fund models designed. And so, I guess as you're talking through all the variables, I was thinking, well, corporate income tax, big concessions around like R&D spending and whatever, and like if that's part of the model construction. And then I can just spot in a second question. I've heard quite a bit about like agent-based modelling as being this new frontier in economic modelling, but I don't really have a sense of like, in you describing this seat here, it sounds like you are modelling individual agents, individual industries or representative households. Where's the line between agent-based modelling as it's emerging field and CG as you've described it?
Okay, so they're good questions. So I'll take the first one first, right? Let's go with the expenditure question. Now, expenditures are something that, so let's dissociate expenditures on things like the hospital system by government, defence, public administration and things like that, from expenditures on things like the first home buyer stamp duty exemptions and concessions, right? Or first home owner grants or even rent assistance, right? So none of those are in the Australian national accounts, right? Believe it or not, where they live is in transfers to households, in supplements to household income in Australia's system of national accounts, which is, world leading, right? But most recent work at COPS has gone into beginning to put that detail in, right? So we, as a core, start with the Australian national accounts as the initial snapshot of the economy. And then we recognise that there's a variety of deficiencies in that snapshot, and we go about putting that detail into place to fix that. Right? A good example is insurance duties. In the national accounts, if you look at them, actually about 50 to 60% of them are collected from superannuation, which is wrong. It's actually collected from life insurance. Right. So anyway, we fix that, and we also put the expenditures in place, and then we start to enrich the picture. So I've given you a big snapshot here of what the marginal excess burden of revenues are. You can also think about the marginal excess burden of expenditure. How damaging to welfare is $1 more of expenditure on a certain expenditure line, like first homeowner grants or rent assistance or shared equity schemes, et cetera, right? You can think of many, many of them. But that's our latest work. So we've begun to rank them on that, right? And then also try to understand how changes in these expenditures, they might not be good for efficiency, right? Maybe, right? But they have other purposes. For example, improving accessibility to housing or damping the impact of rental price rises. Right. So it's actually really broad. What I want to try to, and unfortunately I haven't got time today, but we've got a model with 10 million variables, right? One variable can't rule them all. right? It's not like Lord of the Rings, right? Right? So getting away from us modelers being asked to report on excess burdens constantly, because the picture is so much richer when we broaden it a little bit and we think of a dashboard, right, where things like housing price are important, right? Things like rentals are important, right? Because they impact everyone's day-to-day life. Housing prices don't even figure in these models by default. So that model by Federal Treasury didn't have a housing price in it. Would you believe it? We've, over the last 2 years, over COVID, about 12 months of my life was devoted to putting housing prices into this model, which is really hard, right? But we did it. So in this model, there's housing prices now, right? And we can report on housing price impacts of tax policy change. So reporting on that stuff's really important. It's not just in the welfare metric, it's actually in everything else as well. Yeah.
Ismail?
One of the earlier slides, I think, had gambling taxes in it.
Yeah.
And a high.
Yeah. Yeah, that's a great question. Yeah.
Is that because of this fundamental issue that welfare here is a reduction in gambling is considered a bad?
Yeah, well, in this model, right, the welfare metric doesn't take account of reduced incidence of problem gambling, right? And you've hit the nail on the head with one of the other limitations. So remember the ruler that people use and always ask about it when you're confronted with modelling, right? So how are you measuring that welfare number, right? So if you get some kind of piece come across your desk from an agency, right, who's been asked to produce a report on a new mine somewhere, ask them how they measure welfare, right? Because it's important. Sometimes things are missed. And there, you've hit the nail on the head. We didn't have reduced incidence of problem gambling as being a good, right? Something that society benefits from. We just had the change in the returns to the endowments within the nation and the way they generate income, right? That's it. So, yeah.
Rachel, did you have a question?
Yeah, sort of. And that goes to one of the systemic issues with this sort of work. But the other one that I've just been thinking of as you went through the presentation is that this stuff is so important and information, but it's also really complicated and not accessible to most people, including a lot of the organisations that do public advocacy and campaigning. So you gave an example of where your work was really critical in starting with the terrible tax. But what would have happened if you hadn't done that? How do we ensure that the systems improve so that that better work and hopefully also some kind of better measures are incorporated into the measurement that goes to the policy making?
That's a really good question. I actually think some of the frameworks are in place already. So we've got Federal Treasury typically asked to produce reports of, the kind that they produce for incumbent governments, but then there's Parliamentary Budget Office that is there for other political parties in order to cost policies or to investigate alternatives. I think we need to make sure those kinds of organisations are appropriately funded and that they have the capacity to access tools that aren't exactly the same as what Federal Treasury uses, right?
Yeah,
different tools.
PBO doesn't do this kind of
They don't do this kind of modelling, right? But they should have access to different tools, right? Not necessarily our model, but different tools, right? That Federal Treasury. And then if the different tools come up with the same answer, right, then that's pretty good, right? That's a layer of authentication that should be there. But I don't think it is entirely at the moment. This was completely unfunded. We did this off our own bat. So Janine was flying all over the place, giving talks in Adelaide on it, giving talks in Canberra. I think she spoke at the National Press Club on it. So she did, phenomenal work, all funded off COPS's, budget. I think it's important that organisations like PBO are funded to be able to do that kind of work, or other organisations. But we've got PBO there, so they should probably, have the tools available to them to do that and the expertise. Yeah.
We have a question here.
Yeah. Just wondering how you sort of think about and assess the external validity of your model. Like, you've got more detail than Treasury, but it's still a huge simplification of reality. So, do you go back and sort of do kind of historical tests, like how
Yeah.
How would your model compare to reality? Like, how do you do that process?
Yeah, so we have. That's such an expensive job. That costs, we did a project using a global trade model on answering that exact question. So how well could you have done in 2004, right, in forecasting out 10 years from then with one of these models, with all the information you had in 2004, right? And how good was the forecast, right? And the forecast turned out to be horrible, right? But then it goes into understanding why it was horrible, right? And that costs us about $500,000, right? Massive backcasting exercise. But identifying all the factors that were important in generating good forecasts then it's all kind of documented there. So we do try to do that because it is important to give people some confidence. And answering other questions, right? So how good was our forecast? Well, not very good. The other question may be, how good were other people's forecasts? Were they better or worse? Actually worse, right? So part of it is, how good does your model framework do to others, and also how good does it do in general, right? They're kind of both really important questions. Yeah.
Oh, sorry. We're probably at the limits of which I can keep pushing back time. Sorry, but if we have time at the end, then we can certainly take a couple more questions. But can you join with me for thanking Stephen? It was a really fascinating presentation. So I don't know if some of you picked up in response to Josie's question about what are the best ways of taxing wealth, or how we might go about taxing wealth, that John Quiggin essentially replied the best way of taxing wealth is to tax income, and to tax income on a comprehensive basis, or what we would call economic income. And so when he says things like you tax gifts, that's income because it's any economic gain coming to a particular person over a period of time. And so that's why John and myself think the income tax plays such a key role in taxing wealth and in taxation generally. And so when we have tax policies that move away from taxing wealth and taxing capital, then that has consequences across the whole spectrum. So what I've asked Miranda to do today is explain how we go about measuring our different tax bases of income, consumption and wealth, and particularly talking us through this idea of economic income, which we call Shands-Hague-Simon's income, to give you an idea of the differences between the different tax bases. So Miranda probably doesn't need much of an introduction. She's the head of the Melbourne Centre for Commercial Law and heads the tax group in the Melbourne Law School. And so I'll invite Miranda now to give the final presentation of the day.
So what I want to do, there's a bit of this overlaps with John's presentation, so I won't spend a lot of time, but I've updated a couple of his numbers, so you might find that interesting. What I'm thinking about here is really this concept of the tax base. So there's a lot of debate, our most recent tax policy debates are about tax rates, and we do get a bit obsessed with rates, I think, and there's a kind of illusion that changing the rates is reform as well. Paul Tilley, who's actually just about to publish a book on tax reform and tax reviews in Australia over historically, which is kind of a useful input into tax reform debates today. It should be out by the end of the year. He said that for you to assess tax reform, you need to have a whole of society perspective. So does this change have a beneficial impact? So what Jason's presenting is the sort of what you could call the economic beneficial or detrimental impact. Okay, so to do that, we need to think, okay, what do we mean by the tax system? So there's all sorts of lines that we're drawing all the time. So it's a bit like Jason saying, you always need to ask, what do you mean by welfare in the model? What's the metric? What's the measure? So the same, what do we mean by the base? It might depend on the context. So the first part of the base is, what is a tax? Like actually what is inside the debate and what is outside the debate. So I figure you guys probably know what a tax is, but compulsory and unrequited payment to government. So it matters what a tax is because whenever you read tax statistics, those OECD comparative numbers that John presented, it depends on this definition. It has to satisfy this definition
in order to fit into that statistic, right? So if there's debate about the statistic, it might be because there's a debate about what is a tax. So always sort of thinking about that. I thought it's useful as well to kind of tell you the constitutional definition of a tax, the legal constitutional definition in Australia's constitution. It's rather similar to the statistical or economic definitions that we use. That's pretty hard to read over here, isn't it? A compulsory exaction of money by a public authority for public purposes, enforceable by law. That's pretty crucial, right? It's not just some arbitrary fee or gift or whatever. It's not for services rendered. So anyway, there's various other things. In Australia, I've just put it at the bottom line, it's also important that all Commonwealth revenues go into consolidated revenue, have to go into the consolidated under our constitution. So, we often talk about tax reform. Well, could we earmark a tax to a benefit? Could we create that link? The answer is legally, no. We cannot do that legally in Australia. We cannot say we're going to do a new tax on health or on people to pay for hospitals. We can politically do it, and we politically do it all the time. That's what Medicare is for. That's what, but that political statement is highly misleading, because actually Medicare doesn't pay enough money for hospitals. It doesn't cover the health system. So it's actually a distraction rather than an accurate representation of anything that we do in the system. So it's important to remember that all revenues at the Commonwealth level, states are different, right? States can earmark if they want to, right? They can have money going into different buckets from different sources, but at the Commonwealth, we can't do that. Okay, so just to kind of give you a few little boundary examples, I won't go through all of these. Are these taxes or not taxes? Well, it might depend on what debate you're having. So again, it depends on the context. So HECS and HELP, some of you have HECS HELP debts, I'm sure, or so it's a loan, obviously it's a debt. Legally, it's not a tax. The Commonwealth actually records HECS as an asset in the budget. The debt owing to the Commonwealth, it's an asset. But for low wage workers in Australia who have a HECS debt of, I don't know, an arts degree at Melbourne, $50,000, and you're a low wage worker, you're never going to earn more than $70,000 a year or something, and maybe you move in and out of the labour market, that HECS debt is never going to go away. So for that person, whenever they are in the labour market, they will pay a higher level of tax, which is the HECS on repayment in the tax system on top of the personal income tax. So it's not a tax, it's a repayment of a loan from the government. It's still concessional lending. If you can afford to rely on HECS, you should, right? It makes sense. You didn't have to pay interest on that debt, right? So it makes economic sense. But if you can't afford it, if you never earn more than a certain amount, it's essentially a tax on your loan. So I'm increasingly interested in HECS because I think as a policy problem, it's really a problem for us. It's a problem for our investment in human capital. But I don't want to go through all of these examples, but you can see that sometimes, depending on the policy debate, these are inside our debate. Is it a tax? Should we be levying these things or not? Should we be treating it as part of our tax policy analysis or not? You talked about royalties. So royalties you could think of as a price, a return on non-renewable resources. We own the royalties. We're sovereign in Australia. We own the royalty. Should be a price, but it's often treated as a tax for kind of economic efficiency or other arguments. Okay, so that's the first thing, is what's the fundamental base that we're talking about when we talk about the tax, and that's just the summary. You saw John Quiggin presented basically Commonwealth taxes and state and local taxes. So just to kind of reiterate that summary. It does matter which level of government. In particular, most gambling taxes are at the state level. And you could argue our state governments are somewhat addicted to gambling revenue, about 15% of the Victorian budget, gambling revenue. So we get the efficiency thing. Gambling's good for the economy. It's also good for the fisc, right? It's good. It's so the social harm side of gambling, the personal harm and the social harm, doesn't factor into either our revenue count or our economic count. You're going to have to bring that into the story. else. So just again to sort of summarise the tax, this is a 21-22. I think John had presented stats a little older. But what you can see here is that the income tax, individual, company and super funds, that's all income tax, is about 2/3. It's actually closer this year. Currently, it's closer to 70% of Commonwealth taxes. 60, about 2/3 of Commonwealth revenue, including non-tax. So the income tax is really a very important part of the system. It's a mainstay of the system. And I guess a key part of the message from me, and I suspect from others here, is that that's not a bad thing. Arguably, that's a good thing. Now, we might debate, but it's not just about revenue. And the other thing to note here is the GST raises less than you might think. Is a less important share of the revenue base. So when we talk about broadening the base, which is a mantra of tax reform that I'll come back to, even if we broaden the GST base quite a lot or raise the rate quite a lot, we still are not going to, we'll have some marginal effect on revenue. We can grow revenue if we do that. Absolutely, we can grow revenue. So that's a positive of doing that. It still is probably not enough to solve our revenue problems if you think we've got a revenue problem. Because you can see it's still only this rather small component of the full Commonwealth revenues. So when you talk about broadening any kind of tax, you need to sort of think, what's the overall impact going to be on the system? That's expenditure. I will hand these things out later, I think. So it's a useful little chart about expenditure. Just the point I like to make here is that public debt interest. So you can't get that number easily out of the budget. You have to dig into other purposes. It's like buried in a table in the back of the budget. 4% of total expenditure, which is not very high. So you could, again, if what you're thinking about is balancing taxes as a base for government expenditure, and debt. And what are the pros and cons? What are the risks? At the moment, even this is post-COVID, right? Even post-COVID, interest was still only 4%. Now, interest rates have gone up. So there's a kind of trend, there's a dynamic problem, as you heard Jason talk about dynamic effects. But again, you need to think, when you're thinking about financing government and what you want to do with taxes, also what is the pros and cons of using other sources, especially debt. Okay, and I guess the last thing, thinking about the base, so this is John, I think John Quiggin presented the sort of trends over time for revenues. So this is Commonwealth revenues over the last century. The blue is the Commonwealth and the orange is the states. So you can see again how important the Commonwealth is in revenue. And we are very unlikely, I would say, to see much increase in state revenue as a share of total tax revenue. We might seek to reform some state taxes. And in fact, the biggest bang for our buck might be the economic benefit of reforming state taxes. And you got a bit of that from Jason's presentation. That's why the land tax duty argument, that's why the remove taxes from insurance argument, they don't raise a lot of revenue, right? It's not about improving the revenue performance of the system. It's about generating more national income and better return, economic return. So the equity stuff, the fairness, the distribution, the funding the welfare state, the funding health and education, where does that come from? It comes from the Commonwealth. That's where we have to find the money. Okay, one more thing that's a kind of background thing I wanted to point out is this question of who bears a tax. So it's been a bit implicit in what other people have said, so I thought it might be useful to highlight this, because it does go to how we think about the fairness of a particular tax, is who is bearing the economic burden, or if there's a particular concession or exemption or subsidy, who gets the benefit of that subsidy. Ultimately, it can only be people. It's only people, right? It can't be some abstract thing, a mine, a company, right? Those aren't real people. Those are kind of objects rather than subjects. So it can only be people. And the economic incidence is often very different from the legal incidence. So who has to legally pay a company or legally withhold and remit is different from the person who bears the burden. And working out who bears the burden can be difficult as well. So in particular, transfer duties like house price duties, stamp duty, is it the seller of the house who bears the stamp duty, or is it the buyer of the house? Or if we've got a first homeowner grant, who gets the benefit? Is it the buyer who's buying the first home who gets the benefit, or is it the seller? And you can see that that's because the tax gets put into the price paid for the house. So taxes get shifted, the burden gets shifted in the price. And it doesn't always matter. Like, I'm not saying you always have to work this out, but it can be important to remember. Like, for example, if you're thinking about company income tax, it is important to remember that it's not the company that bears the burden of the tax or gets the benefit of a lower rate or something. It's actually the underlying investors, the foreign investors in Jason's example, or underlying Australian investors, super funds, right? Which is all of us investing in corporates, for example. Okay, so I've just, again, if you just scroll through quickly, this just to give you example each of these sorts of things. I won't go through them all. And one of the other things to think about with tax incidence in terms of understanding the burden is that economic theory often assumes an incidence. So the GST, it's assumed it's borne by the consumer, the ultimate purchaser of the good or service, even though it's paid, it's remitted by the suppliers, right, through the chain. But that depends on the market, actually. It depends on how elastic prices are and as Jason said as well in his model, producers and consumers are different. Right? They have different positions. They have different responsiveness or elasticity to taxes. Sometimes that might matter. Okay, so now just leaving it here for a minute. So there's two things we might want to think about in thinking about a tax law. One is, what do you need to have a tax law? What does the law have to tell you? We need a definition of what is taxed. So legally, that's what we call the tax base. The definition of what is taxed in that particular law. We need the tax rate. We need to know when the tax applies. Is it annual? Is it for, how frequently? Is it just when there's a transaction? We need to know who is taxed. What is the individual taxpayer? We need to think, very difficult problem, how are intermediaries treated? So corporations, trusts, super funds, partnerships, these are all legal entities that are not real people, that are into what we call intermediaries in the system. And that's where a lot of the complexity lies. And we need to understand the borders, the national borders. So if we go on to the other side, to administer a tax law, it's kind of similar. We need to know who is it that we're trying to tax, who are the taxpayers. We need to have the ability to find the transaction or the income or the metric. We need to be able to have a bank account that we can see, the administrator can see and get the data. We need to be able to measure it. So one of the reasons why land taxation, although ideally very good economically, but why in practice it often isn't as good in practice as it is in theory, is because it depends on periodic revisions of land value. And if that is not done, if land valuation is not kept up to date, land taxation can be rather poor, actually, and not such a good measure. So it depends on us having the capacity to administer the tax. We need data, we need enforcement powers, and we often need reinforcement, like a way to triangulate so that we can check the data, reinforce. So I guess the thing to remember when you're calling for tax reform is, how does it measure up? How would we design a law that does the tax, actually does it, creates it? And how do we administer that tax? What are the risks? What are the problems, the pressure points? And this is one reason why wealth taxation is something that tax reformers struggle with, because we have to measure that wealth. We have to get information about that wealth on a regular basis. We have to capture the legal owner or the controller, which may not be the legal owner of that wealth. And we have to recognise that, especially if it's financial wealth, as opposed to land, that it might go offshore. And we have to then find it offshore. So there's a lot of constraints about that are still problematic even in today's era of data. Okay, so you've got to think, if you're thinking about reforming the tax system or the base, can we design a law that actually will work? And can we administer that law appropriately? And we're getting better at these things over time. We're better than but still lots of issues. Okay, so now let me get on to what actually Catherine asked me to do, and I'm probably running out of time. So lots of different ways we might define, I will talk about Hague Simons. We might define the tax base, and again, it depends on the context or on who is talking, where they're coming from. So economists tend to talk about factors of production, labour, capital, land, right? That these are the base. This is the base for taxes. You might also talk about what is called the uses, or sort of I don't know how to describe uses. You're an economist, Jason. You're a mathematician, really. I don't really know what we mean by this. We tend to talk about income or consumption as being the uses of the economic return that is derived from the underlying factors. Is that accurate enough?
Yeah, so I think it's things like the savings rate and stuff, they're like behavioural parameters.
Behaviour, so how people are, but that also can be a tax base, right? That measure of income or measure of consumption. We'll come back to that because that's our most common, in a way, tax base these days. We could also talk about the tax base as the stock of something. So that requires a valuation at a point in time. We have to be able to identify, measure and value it. So land, a land tax, we have a stock of land. We identify who holds it, what its value is, what its dimensions are at a particular point in time. Or we might look at flows in the system. Income is a flow, labour, wages is a flow, right? Consumption is a flow, our outgoings to supermarkets or retailers or whatever. And we track the flow, and because there's transactions that we can measure, we can then use that as a base. But you might also see tax base used in a few different ways. So I just wanted to highlight those. Sometimes just who is taxed. So it might be that we miss, we're not taxing people in a particular industry sector very well because they work in the cash economy or something, and we're not capturing them. So you talk about the gig economy, somehow they're not in the system anymore. They've somehow got outside the wage system. So we might want to expand the tax base to capture people in the gig economy. Right? So you could think of the population being the tax base, or it might be particular transactions that we want to bring into the base that we haven't previously captured. So the GST was reformed 5 years ago to capture online shopping, right? Digital shopping, Netflix, Amazon, low-value goods, previously not taxed in the GST. So we expanded the base of the GST. The states did agree to this, to capture buying from Amazon, buying from Netflix. That's an expansion of the base. Okay, so a famous reformist view of the base is the Henry Tax Review. But as you've heard, quite a lot of their recommendations were premised on economic modelling of the efficiency of these tax bases that, has assumptions and limitations, right, that you have to remember. So personal income, you notice they refer to the idea of it being on a comprehensive base. I'll come back to that in a minute. Business income, so that's also this idea of income as a flow, but they have this idea of designed to support economic growth. That's code for at a low rate, because the assumption is that that's more efficient, which is premised on the modelling COPS critiqued, right, or partly on that modelling. Economic rents, so these are returns you could think of as price returns, super returns to these assets that kind of belong in Australia. We might say we want that. We want to capture that rent and consumption. This is what the Henry Review described as its kind of ideal tax system, is to do this. In fact, our tax system already does this. It's just Henry said it should do it better. Okay, so the income tax, so we tax something called taxable income. Doesn't tell you very much. Income as defined in the law, less deductions. And Catherine and I could talk to you ad nauseum or answer any question you might have about what we mean by the legal idea of income. And look, I won't worry about the tax rates, but I've given you the links there. Okay, so let's go to the next one. So just to go back up to remove my equation for a minute. So this economic concept of income, what we sometimes call comprehensive income, Or if you go to the next one, then Shands, Haig, Simons. So these were economists of sort of the last century. Shands and Haig were German. No, Haig was American. Shands was German, late 19th century. The Germans always invented these things first.
And then the Americans.
Haig and Simons, the Americans took it over and claimed it for themselves. So Henry Simons is the most famous originator of this concept of comprehensive income, 1936. So it's a pretty old idea. So what do we mean by this concept of income? We use an equation. Income is represented as a Y to distinguish it from interest, which is often an I in sort of economic math algebra. So just if you see a Y, you're like, what is that? It often means income. We've kind of got that. So this is a kind of a relation, right? That income, it's not equal in any kind of numerical sense. It's an equivalence. Comprehensive income is equivalent to consumption and the change in net wealth in a period of time. You always have to have a period of time. Doesn't mean anything if you don't define the time. So we talk about a year usually, right? That's the tax year. So what we would call your comprehensive income in that year is equivalent to your consumption in that year and your change in net wealth, either up or down, positive or negative. So if you go on to the next one. So this is what we consider to be equivalent to your net gain, your economic net gain. So you're that much further ahead than you were at the start of the year. So it's the net gain in the year is what we would define as the benchmark idea of income. Okay, well, what does this mean? And the reason why we say it's a benchmark is that you'll see in all the tax reviews, Henry, Rethink, most of them, there is this idealised concept, and then can we improve or reform our system? Perhaps to get more like that, or alternatively to move away from it. So going on then, that's our relations again. So I just thought we'd do a couple of little examples. So if you could click on the next. So why don't we see, get a bit of audience participation. So Joe has 1,000 of savings at the beginning of the year, right? There's $1,000 in the bank. And Joe earns 500 wages in the year and earns $10 of interest on their savings in the year. And in that year, Joe spends all of the earnings, like all 500 on rent, but the $10 of interest is still in the bank account at the end of the year. So what is Joe's comprehensive income? It's pretty simple, I hope. Anyone want to? $10. It's more than 10. It's 510. It's 510. So it's kind of what you'd expect, I hope. For a start, we ignore the savings, right? So it's only the period of time of the year. So we had 1,000 at the beginning of the year in our savings account. We still have 1,000 at the end of the year, plus 10, in fact, in our savings account. So it's only the period of time. It's not exactly, we wouldn't just say the wages is your comprehensive income, but the fact is that we've spent all those wages on our consumption in that year. So we've paid our rent and we've bought our food, and that has cost us $500. And so we would treat that as going into the income, and we've got $10 that we just still have. We still have that $10 at the end of the year. So we add that in. So 510. I mean, on this relation, if Joe had actually had to use some of the savings for living, if we actually had to pay 600 for our rent and food, then our income in that year would be 610, actually, because it would be our consumption in the year, even though we're using our savings, but we would have kind of netted it off from the previous period, I suppose.
You net it off with a negative change in wealth.
We would have a negative change in wealth. That's true. So we'd use 100 of our savings in our consumption, but then our savings would go down to 900. So you're right, we net it off. That's true. So it can be difficult to see sometimes, but it's the comprehensive income idea is not the same as the flows right? It's the combination of what you consume and your net wealth at the end. It's often the same as the flows, but it's not always the same.
I just asked to clarify, is comprehensive income, is the statement that that's how we currently compute income?
No, this is the ideal. This is the ideal, but it's not dissimilar if we're just talking about wages and consumption, it's actually pretty close to what we actually do. So we do actually, what we would do in our real system, what would come in as taxable income would be your 500 of wages in the year, and your $10 of interest income would both come in as taxable income, and we would tax them, and we would ignore the 1,000. So actually, in that instance, they're identical. So our income tax is very close to comprehensive income when we look at labour income. It's pretty close. We do allow deductions for expenses, but so would comprehensive income allow that. So if we do another example, so what about if we have someone who's an investor? They have shares that are worth $10,000 at the beginning of the year. They get 300 of dividends coming from those shares during the year, and happens they spend it all. And then at the end, the shares have gone up in value. So now the shares are worth 12,000. So what is Peter's comprehensive income for that year?
300.
Yes. So meaning 2,300. That's right. So we include the flow. We received the dividends, but we only include it on this equivalence because we consumed it all in that period. So it's kind of equivalent to consumption. We spent it all on things that we used personally. And our asset has gone up in value. So we have an accrual or appreciation in value of our wealth. Our net wealth has gone up by 2,000. So comprehensive income here, $2,300, even though we did not sell the shares. So that's a critical difference between our current system and the ideal system, is that in our current system, we usually require realisation or sale of the asset in order to generate a monetary return. Not always, but usually. Whereas comprehensive income would tax on an accrual basis, that net gain. What if Peter's shares went down to $8,000 at the end of the year instead of being worth 10? So then we have a negative wealth. So what's our income for the year? It'll be our consumption of 300 minus 2,000 actually. So it'll be a loss. We actually have a loss economically of 1,700 if the shares are worth 8,000 at the end of the year. So we should have symmetry, right? Comprehensively, we would recognise the loss. And then a final example I wanted to give, because this is sort of relevant. One of the other things that the economic concept of income includes is what we call imputed income, or imputed, in particular for housing, imputed rent. What is that? It's the benefit in kind, the non-monetary benefit that you get from living in your own home. So if we have Ching lives in their own home, do they have any income? Nothing else has happened. Let's assume there's no other flows happening, and let's ignore the value of the home. Nothing happens. It's worth the same at the end of the year as it was at the beginning of the year. Does Ching have any income comprehensively? Yes. It's the equivalent of the amount of rent Ching would have had to pay to live in that home. So when you think about home ownership, the home could be bifurcated into an investment asset and a consumption good. The consumption good is the consumption of what you could call housing services, the benefit for you of living in the home. It also has an investment asset value, so you could treat it as wealth. So we can bifurcate the home into consumption and wealth. Yeah.
How would debt be treated? Someone takes out a payday loan, consumes it.
Well, the consumption, so the income would measure the amount of consumption if it was 100 as consumption. So that would come in as income, but you have a matching liability. You've got this, so your net wealth is negative if you have debt. So you'd have a negative 100 for your debt obligation. So you would have zero comprehensive income. You net them out. Yeah.
Miranda,
Yes,
you're just
conscious.
at time. So I just, maybe if you finish on your next slide,
Yeah.
but I just want to just ask you to speak to one more thing on this, is that the useful thing for the Shands-Hague-Simon definition of income is you can flip it and see what happens when you have calls to move towards more of a consumption base. So when you flip the different factors in the equation, if I had a whiteboard, consumption equals income minus your changes in net wealth. So it's excluding changes in net wealth when we move to a consumption base. And that obviously has profound distributive implications when most of the net wealth accrues in the hands of a few. So the really useful thing about this equation is to see what happens when calls are made to shift reliance or changes in the tax base.
Yeah, no, that's right. So when we say this is an well, actually, I will show you. I just wanted the other reason for the home thing, sorry about the time. So if you rent your own home, if you pay rent, you're a tenant, in our normal system, can you deduct that cost? Is it deductible? It's not deductible, right? It's not. And in a comprehensive income tax, it would not be deductible either because it's not about generating income. And so we get a very big difference if we have a system where we don't tax homeowners on their imputed rent, but we do not permit renters to deduct the cost of their rent from tax. So we get a bias in our system. And in fact, Australia did until in the early 1920s, we did tax imputed rent. Most countries, their income taxes early on included a number for imputed rent, the benefit of living in your own. We abolished that. Okay, so there's a number of differences. I won't go through them all, but the key one is realisation. But what I might show you is this. So this is partly getting at what Catherine, if we go to the next one, what Catherine said, and then we can go to a discussion. So Australia's real income tax is really a kind of hybrid income consumption tax. And the reason for that is because we have moved towards lower taxation of key elements of saving and wealth. Remember, income is equivalent to consumption and your change in net wealth. So if you just get the next, there's one more, yeah. So we have the CGT 50% discount. We have a full exemption for the main residence from income tax. We do not tax imputed rent on the home. I didn't include that in the list. We do not tax gifts and inheritance, both of which tend to be accretions to wealth. And we have low taxes on superannuation. So we're familiar. So when you put all those things together, we no longer we're kind of far along the spectrum from a comprehensive income tax, the ideal income. We've moved towards an expenditure or consumption tax because we've removed net wealth out of the base. So when we talk about broadening the base for tax reform, we tend to, in an income context, we tend to be talking about moving ourselves back towards comprehensive income, bringing investment, savings and wealth back into the base at progressive rates. And we could talk about the company side as well. But yes, sorry, Catherine.
No worries. Thank you.
Yeah.
Right. Well, please join me in thanking Miranda. Just in terms of time management, I'm not going to take long to wind things up. So we've got about 10 minutes questions. So if anyone has any questions or comments for Miranda.
Everyone's having trouble kicking away.
Yeah,
sorry about that.
No, it's a hard gig, last speaker. Toby.
I'm just wondering, so the sorts of things on this slide about how we move towards that comprehensive income seem to be about defining, what's in and what's out. I'm wondering about the sort of the temporal element where, you kind of mentioned changes to wealth happen every period, and yet we only tax the gains when they're crystallised and well. Is anyone sort of talking seriously about taxing changes to assets as they occur?
Well, we have a superannuation reform in the mix at the moment, don't we? where we have super balances over 3 million, every quarter those superannuation balances get revalued for regulatory purposes. And so we will have a tax under this government, an additional 15%, bringing that tax rate up to 30% on the excess, which is essentially that. It's a tax on the accrual of the net gain in the period of that asset, even though the super fund has not sold the investments, right? They have not realised the gain, but we will be taxing that net gain. And for large businesses and corporates, we have something called taxation of financial arrangements, which nobody ever wants to think about ever. But we tax essentially large financial businesses, in particular banks and stuff, on an accrual basis. So we already do it, right, mark to market with their net income, in particular their various securities and equity investments. They value it every year. But no, in general, no. But this is one of the big questions, is whether we should have a deemed rate of return, or move more towards an accrued return, because the realisation requirement has some advantages, because that's when you get the money, right? You get the money to pay the tax. But deferral into the future is a very substantial economic benefit. Delaying the payment of tax is a very substantial. It's an interest-free loan from the government. So, if you like, compared to the comprehensive phase. Politically not popular.
Do any other countries do that for assets like housing or?
So there's a few countries that do have a deemed rate of return approach. The Netherlands is one example. They have a box. They call it the box system, where they have a deemed rate of return. To be honest, I read recently that they might be moving more towards realisation. So even though they've had that system for about 20 years, we used to tax imputed rent with a deemed rate of return. So that's one way to do it, is you just have some metric where you say 3% on the asset value or something. We just treat that as income, right? And you kind of bring it in as a proxy for the net gain. Yeah.
I should add, there's a bit of discussion in the United States, both at an academic level and at a political level. I think I was talking to Tom about this the other week. There's a couple of, I think, Congress members that introduced a bill that went nowhere, that was tax wealth like wages. So there are proposals to tax basically capital gains on an accruals basis, getting discussed in the US, but it's a long way off actually getting enacted. But I can certainly send you the resources.
Yeah.
So if the council rates would be an example of where, because your house gets revalued and your rates go up accordingly.
So that's where you can see that an income tax looks like a net wealth tax. We're talking about the net wealth bit of the income base, really, is that asset value. So a land tax or a council rates tax, if you've got good valuation of that asset, and you just bring in. The difference, though, is that that's a tax on the stock, the total value of the stock. So in the income tax, it would just be the net gain in the year that we would bring in to tax. So the actual size of the base is very different. Council rates and land tax, it's the total market value of the asset that's taxed every quarter.
And if you were going to tax imputed rent, or the benefit I get from being a homeowner, then do you have to also provide a concession for
home mortgage interest? Yeah, so that's the big downside, actually. So I would probably argue that although ideally we should tax imputed rent, and we have very substantial housing inequality in Australia, we know that's one of our big policy problems, that actually not taxing it and then exempting the home, it's equivalent to a consumption tax treatment of the home. And given the trade-off of not having to give a home mortgage interest deduction, not having to require homeowners to keep track of all their expenditures, renovation costs, other costs, repairs, it's probably better to leave it alone. That has
inducement to keep paying interest as well.
Yeah, you generate perverse incentives in the system like we see for our landlords now. So, I mean, the real world tax law response to a problem like that, in my view, has to be arbitrary. You just limit deductions, or you just apply a low rate at the top for properties over 20 million or something. You just tax them, kind of, and you don't give them any deductions, right? You've got to, which is not very pure from a theoretical perspective.
Okay, we might finish with Josie.
So I was kind of, would I say if you had a more comprehensive income tax system, it might lead to kind of better outcomes in terms of inequality, I guess, and or more, I guess widening the tax base. So
yeah.
And these measures that you've kind of identified here, I mean, are there particular ones that would make a real impact if we were to kind of reform them in terms of, I guess for Oxfam, one of our things that we think about it is that there's this real growing inequality gap in wealth in Australia in particular.
Yeah.
And like, what can we do to address that?
Yeah. Yeah. I mean, I think, so if you go back one slide, it's sort of, why do we care, right? Why do we care about the tax base? And the argument is that from a tax reform perspective, we may want to just broaden the base and not just fiddle with the rates. And that's partly because you could achieve a political compromise potentially by lowering rates while broadening the base, and that's not an uncommon approach. That does sort of happen. But more it's because the bits of the base that we tax labour income very well and very comprehensively. And the reality is that the bit of the income tax we don't do so well is capital income and gain, right? The net wealth bit of the story. And that means that there's also a chunk of consumption that we're not capturing at the high level either. So people who finance their consumption with capital income, which is lower taxed. And so, yeah, I think that reducing the CGT discount, bringing progressive marginal rates potentially back, and responding to tax planning. So the base can be narrowed just by tax planning, and that's what negative gearing is. It's not a special rule that gives you a special concession if you're a landlord. It's just gearing, that's all it is. And so we just have to stop that behaviour. And that would in itself broaden the base a bit. So, yeah, I think that's where we have to focus our attention. In fact, arguably, we even tax labour income too much relative to capital income. So we need to be evening that out a bit. Yeah.
And it used to be the case at the start of the last century that they taxed
reverse.
the reverse.
Yeah.
Unearned income was taxed higher than earned income. So, yeah, it's a real flip.
Yeah.
Great. Thanks so much again, Miranda. Thanks so much to everyone for coming today. I hope you got a lot from the event. I certainly did, even as someone who does this stuff a lot. So I hope it was valuable to you, and yeah, really welcome your feedback. We have no formal way of getting that. We might perhaps send a quick survey or something afterwards. But yeah, thank you so much for attending and for your contributions. Just a few quick thanks. Firstly, to all the people I had help organise the event, to Avril, who's been monitoring the Zoom today, to Astari, who came with me yesterday and set up the room, to Angela, who's been busy promoting our event to the sector, as well as to Carolyn, who helped set up today, and to Claire, who also set up today. Thank you so much. I could not have done this shuffle to a new premises without you, so I really appreciate it, and you definitely deserve a round of applause. The speakers have all kindly agreed for us to distribute their slides to you, and we will email those to you after the event. So yeah, so thank you very much to our speakers for doing that, and thank you to our speakers. We've only got 2 of them remaining, but really value your time and your contribution today. I got a lot from your presentation. So we have a modest gift for you each, which will have no tax implications. But yeah, so thank you very much, everyone. I really appreciate it, and look forward to continuing the discussion around taxation now that I've found some friends who are happy to do it. Okay, thank you.